You're about to listen to How to Day Trade the Plain Truth, and I hope you enjoy listening to it as much as I enjoyed writing it. Now, because there's so much more to learn about trading than I could possibly fit within one book, I have put together a bunch of additional resources for those of you that want to continue your education. You can find those by clicking on the link pinned to the top of the comments and linked in the top of the description. These resources include special strategy PDFs that you can download, you can print out and have them next to your trading station. They also include video lessons that describe my strategy in detail and show you the visual examples that go hand in hand with this type of learning. You can learn a lot by reading books and listening to audiobooks, but it helps to make the learning more interactive by showing you these examples of real live trades. So I hope you enjoy the audiobook, and then check out those additional resources pinned with a link at the top of the comments and in the description. How to Day Trade the Plain Truth, written by Ross Cameron, narrated by Ross Cameron. Chapter 1, The Myth and the Reality. This book is about day trading, but of course you already knew that from the cover. I bring it up because that is where the similarities end between this book and all the others I've seen about day trading. Same topic, but vastly different messages. So how is this book so different? First, I will not try to convince you that day trading is your ticket to great wealth. In fact, if your personality and circumstances are not suited to day trading, I'll convince you to stay away from it, thus saving you all kinds of time, money, and frustration. Second, this book is not a thinly disguised sales pitch to get you into ever more expensive training and coaching programs. Let's say you think you might be suited for day trading. You can take the specific steps you learn here and start your journey without ever getting additional materials from me. Third, I will never tell you that I've cracked the code and that I have the only true system for making day trading easy. Quite the opposite. I'll describe how very hard it is to become a good day trader. And you'll see from my audited broker statements how I've become reasonably good at it, but how I'm also far from perfect. You'll discover that I have developed one approach to trading, and I make no claims of superiority over other strategies. Other traders may teach very different strategies from mine, and that's fine. There's no single solution to most challenges in life, and day trading is no different. Everyone has an opinion. In my more than a decade of being in this business, I've been to a lot of social gatherings and events where the icebreaker is usually the good old, "What do you do?" I dread when people ask me that because if I choose to tell them I'm a day trader, I can count on a strong reaction. Usually not an enthusiastic, positive one. After all, if you follow the financial markets and media at all, you can't help but hear of a few so-called day traders who decide to dabble in some hot stock and soon are bragging on social media about how they're up $1 million and will be retiring before the age of 30. Or you might hear about the guy, it's usually a guy, who made some money on a tip, felt like he had a hot hand, and sunk his savings into a stock. He was assured by both the gurus on Twitter, X, or Reddit and the TV network loudmouths that this stock would be the next Tesla or it would be going places soon. Except with no strategy for managing risk, when the stock reversed, his account followed and he became another statistic of a failed trader. Some people experience big winners on beginner's luck, and others will lose it all on risky gambles. A few professional traders survive the ups and downs of the market to maintain a long track record of consistency. For them, it's an uphill battle to explain how the profession of day trading bears little resemblance to public opinion. Day trading sure has a reputation. Why this book? I wrote this book to bring real-world clarity to the sensationalized reputation surrounding day trading. You're going to see throughout this book that I will be very blunt with you. And here's the first instance. Day trading is like a magnet that strongly attracts some people and strongly repels others. The problem is that it often attracts the wrong people and drives away other folks who might be great at it if they only knew the facts. I will fix that in these pages. I have the following goals for this book. Number 1, I must show you that I know what I'm talking about when it comes to day trading. You'll see that the profession did not come easily for me, but that I've been reasonably successful at it. Number 2, I will blow up many myths and misconceptions that form a hard shell around day trading. It's difficult to think of other professions that are as misunderstood, although I'm sure there's some. 3, I'll paint a realistic picture of what day trading is and is not, from someone who's not afraid to show you the good, the bad, and the ugly. As best as I can in book form, I'll give you a sense of what it's really like to sit at a computer and trade stocks like a pro, but also how it will work when you're a beginner. Spoiler alert, the main action happens between your ears. You will get a clear sense of whether this profession is a good fit for your personality or not. I'll provide a detailed and realistic step-by-step path of how you could dip your toe into this business, and then maybe your foot. And then there is at least one right way. I'll cover both of them. Another spoiler alert, you're not going to get any magic keys to day trading in this book, or, quote, secrets that the big guys don't want you to know about. That's clickbait, and it attracts the wrong crowd. A trusted friend. I've written this book with a certain image of you and myself in mind. I imagine that we met some years ago and we've had lots of great conversations. We've been through enough so that we can dispense with the dancing around a topic. In other words, we can talk straight with each other. You know that I've made a living by day trading. For a while, you shrugged and thought, hey, whatever, not my cup of tea, but to each their own. But maybe your circumstances changed. Maybe COVID forced you to work at home, and now your boss is forcing you to go back into the office. Maybe you heard about some crypto traders or about the crazy meteoric rise on stocks like GameStop. It went from $19 to $483 in just 24 days. Or maybe you and I are just catching up one day and you decide to ask me in more detail about this day trading thing that I do. For my part, I've not volunteered much about my profession because I value our friendship, and I figured you're as misinformed about the realities of day trading as the next person. I don't feel like explaining the realities of my career if you're not interested, beyond being polite about how's it going on any given day. I think of this book as our conversation that happened once you sat up and asked me in earnest about the crazy line of work that I'm in, and whether it's possible to make a fast fortune the way people brag about on social media, plus 100 other questions. Because I value our relationship, I'm not going to sugarcoat my answers. I will not tell you what you want to hear. I will not try to convince you of anything, but I'll try to give you a brutally honest brain dump of all the good and the bad. Let's say you're not cut out for day trading. It would be great to find that out by reading this book because I'll have saved you a ton of money and headaches versus learning that the hard way. Then again, let's say you've always thought that day trading was for people with more money than brains. Then you discover from this book that in fact, the real profession is nothing of the sort, and it meshes nicely with your personality. That's an even better outcome. Providing solid, experience-based information is what this book is about. You say you have a bunch of questions for me and you want those straight answers? Well, let's get into it. Chapter 2. Who am I to talk about day trading? The investing world is inhabited by all kinds of people. You have those who lost a bunch of money and don't want to talk about it. A number of people who have made money and have no desire to discuss it either because they're either too busy making money or they think the more they blab, the greater the competition. Let's narrow down the focus to just those people who are willing to give you information or their opinions about investing, and further narrow it down to day trading specifically. These people fall into several groups. The first is they've never day traded, but they know a guy. That guy may have lost his life savings, or maybe he did really well. In either case, the advice is based on secondhand information, and probably partial information at that. Was it really day trading, or did the guy buy a stock based on a hot tip and months later sold it? If you're really a day trader, you buy and sell on the same day. You do not carry any positions over to the next day. Another group of people dabble in day trading themselves, but not by first learning any strategies. Brokerage firms make that really easy to do, assuming you have the minimum amount of money to start and some basic computer equipment. More on that later. People who do this sort of dabbling can sometimes win, but usually they get their butts handed to them. Advice and information from these types of people is going to be incomplete and inconsistent. Now, some people have tried day trading and were serious for a while, but then got burned. They did not have a support system to help them figure out what went wrong and how to adjust their strategy. These traders will share with you their horror stories, but they may not understand the root cause of their own failures. Though they provide a tale of caution, they may be unable to communicate the strategies or the mental processes that led to success. Other people have been day trading and are quite visible online. They might have courses or channels and charge for their services. The only problem is that they only make money on the courses and are not actually profitable traders. They'll be happy to talk about their wins, but they will not share their losses or their broker statements. Then there's the largest group of people. They're happy to dispense opinions to you, but they're only based on what they've heard about day trading through the news media, social media, or the movies. Do you see a trend here? These people do not have substantial personal experience based on putting in the hard work to learn proven strategies and then trade them over a long period of time. The 6 criteria for a good teacher. Let me put it another way. You should only learn day trading from someone who, number 1, has personally done it. Number 2, has traded over not just days or weeks or months, but years. Number 3, has been consistently successful at it. Number 4, will share with you not just their successes, but also the challenges and downright failures. And number 5, can document that track record. By document, I don't mean the occasional tweet of the guy standing in front of his rented Ferrari. I mean audited brokerage statements that cover all of the person's day trading activity. Number 6, finally, he or she is willing to teach you. No one maintains a list of people who meet all these criteria. I'm sure some people meet some of the criteria, and maybe a handful even publish broker statements. Because you took the time to listen to this book, you deserve to know how I stack up to those criteria. Number 1, I've personally traded. Number 2, I have done so full-time for more than a decade. Number 3, in terms of consistency, my accuracy is just about 69%. Accuracy is the percentage of all the trades that have been profitable. Number 4, my YouTube channel has more than 1 million subscribers and over 10 years of educational videos. I routinely upload my daily recaps of trading where I highlight both my winners and my losers. Number 5, I pride myself on transparency. That's why on my website you can see my audited brokerage statements going back years. This audit verifies over $10 million in trading profits. Number 6, I enjoy teaching and I'm willing to teach you. Number 7, and I'm going to add a 7th criteria. I didn't have an easy time becoming a disciplined, successful trader. Far from it, as you'll see in this chapter. I think this may be an important factor because some prodigy who seems naturally suited to a profession may not be the best person for the rest of us to learn from. But Ross, if you were so successful at day trading, why on earth would you be teaching? Isn't it true that those who can't do something teach it? We're getting right into the no-nonsense questions. And that's good. I get this question all the time, and it's a reasonable one to ask. So here's a multi-part answer. I'm pretty sure that teaching is in my DNA. My grandmothers were teachers on my mom's side and my dad's side. My grandfather worked at Dartmouth College. My uncle is a professor at Yale, and my mom was an activity therapist or a type of teacher at a hospital in Vermont. From an early age, I was accustomed to being around people who enjoyed teaching. I'm also a big brother, which meant I was always a bit of a teacher to my little sister. I simply like to teach. Long before I was into day trading, I taught ceramics classes in Vermont. Later, when I was in a trading club, I gravitated to moderating a trading chat room forum. I didn't know a ton about day trading, but I could answer beginners' questions, and that's what I did, for free. More than 10 years ago, I shrugged and decided to do videos while I traded and talk about those trades on camera. I made zero money for quite a while, but that was not the point. It helped my thought process to describe my trades out loud. I also found that my viewers would hold my feet to the fire, so to speak, with their comments. Besides, as you'll come to find out in these pages, there is no reason for me to hold back. There are no secrets in real day trading. There are no silver bullets that give you an edge. As you will see, it's about dedicating yourself to learning a great deal about the markets and how they move and how other investors are thinking. That's cool, Ross. You like to teach. Why don't you continue teaching and simply give it away for free? Why do you have to charge for it? Another good question. I do give away a great deal for free in the form of my continuous flow of YouTube videos and material on my website. Why don't I give it all away? Because I can't. I decided early on that in order to provide my community with the best possible experience, I would need to combine all of the must-have trading tools into one platform. I hired a development team. I built a custom trading platform that day traders are now using all around the world. This platform provides useful information to traders through its stock scanners, stock charts, chat rooms, and live broadcasts. As you can imagine, it costs money every day the platform is online and running. I have no qualms about charging a fair price for a platform that makes it easier for the average trader to find strong stocks and actionable trading ideas. Back to my story. I was born in Brattleboro, Vermont in 1985. My mom worked in the Brattleboro school system before getting a job at the Brattleboro Retreat, the hospital that I mentioned earlier. She worked there for 41 years before being unceremoniously laid off. My dad worked at the Brattleboro Retreat as well, in the building maintenance department. He was a Dartmouth College graduate, like his father and like his brother, and he was a Fulbright scholar. But he had a variety of health issues in his life that greatly affected him. And they also affected who I grew up to become. My mom wanted to make sure I got into the habit of working from a young age. She was sort of my agent, helping me get my first paper route, and then jobs like mowing lawns and cleaning swimming pools. A pivotal moment. I was in 7th and 8th grade at a Montessori school during the dot-com bubble. My teacher, Kevin, did an amazing semester on the stock market. He had us pair up, and my buddy Cooper and I created a dummy portfolio, and each day we'd chart the prices in class and discuss the stocks we were buying. This got me a little inspired, and I think it showed. Another project at school was to pair up with someone and write biographies of each other. My friend Sam took a picture of me and wrote, 20 years from now, Ross will be living in New York City working on Wall Street. The investment portfolio we created intrigued me, so I called my local Edward Jones office and I told them I wanted to buy shares of the American Ski Company. It was trading around 90 cents at the time. The broker said, okay, how much do you want to invest? I have $100, I told him. He said, well, that's going to be a problem. We charge a commission of $50 to buy and $50 to sell. Okay, never mind. The stock market went on the back burner, and I found a new interest in a computer lab at school. I started a business with my neighbor to build websites for different businesses in Brattleboro, and that's when I learned how to code in HTML and also how to do a little graphic design. I enjoyed the feeling of being in business for myself, and I continued building websites for myself and for my friends over the years, including the first website at Warrior Trading. But web design didn't become a continuing business for me. After a while, I developed an interest in architecture and also ceramics. In high school and during college, I taught classes in ceramics to adults and kids at a local studio in Vermont. The coolest kid ever. While in high school, I had another friend named Ben. And get this, as a high school kid, Ben made $16,000 trading a penny stock. Now it wasn't day trading. Ben had been given a tip by someone's dad and he acted on it. With his profits, he proceeded to buy a used Nissan Pathfinder and outfit his basement with an awesome sound system, a jukebox, an arcade machine, and I can tell you this all made a big impression on me. I'm thinking, if Ben can do it, maybe so can I. Now, Ben didn't continue to invest. He blew that money pretty quickly, but it got me thinking. I opened an Ameritrade account in the summer of 2001, and I funded it with my life savings accumulated from mowing lawns, cleaning swimming pools, and delivering the newspaper. It was $1,000. I bought a few shares of companies like ExxonMobil, Caterpillar, Cannondale Bicycle, and American Ski Company. But by the end of the summer, my portfolio was basically unchanged. I didn't have quite the hot hand that Ben did. As I made my way through high school, I put little thought into college, and I did not study for the SAT exams. I had become a very anxious teenager. The prospect of going to college overwhelmed me to the point of paralysis. But my mom urged me to apply to schools anyway, and I got accepted to Colby Sawyer College in New Hampshire with an art scholarship. I studied art and education with an eye on maybe becoming an art teacher. That would allow me to do ceramics, but I'd also have the teaching certificate to fall back on, and I could become a regular teacher if necessary. The downturn. That was the plan, at least. What got in the way were my panic attacks. They began in high school, and they got worse in college. They were bad enough that I dropped out of college after 3 semesters. My anxiety was made worse when my father was diagnosed with stage 4 lung cancer and given a year to live in the spring of 2005. As a college dropout, I was living back at home in Vermont. I was there to help in any way I could, and my mom, working again as my agent, helped me find a job pumping gas at the local Sunoco station. That was a pretty tough period for me, not only because of my father's situation and my anxiety attacks, but because I felt like I was going Nowhere. And there wasn't a lot of ambition among the folks I hung out with at the gas station. I thought that what might work for my situation was to run some kind of small business, like maybe the ceramic studio where I had worked for a while. That might be a way to make a living on my own terms. I began to think I just needed to make enough money to buy a piece of land and build a cabin with a ceramic studio. I envisioned a life living off the grid, selling my work at summer craft fairs and festivals, and teaching as needed. But with a lack of funds to make that dream happen, and with the guilt of having only partially finished my college degree, I decided to go back to college in Vermont. While my father was sick, I attended classes at the Community College of Vermont in Brattleboro. And after my father passed away, I enrolled at Vermont College because they had an online program. Basically, a semester involved reading 15 books for 15 credits and writing a 10-page paper on each of them. I did that for 3 semesters and I got my 4-year college degree. Part of the subject of all those books I was reading involved architecture. I'd focused on mid-century modern, American modern, and European modern styles, with a helping of urban planning thrown in. I chose to study architecture not because it was necessarily more interesting than ceramics, but because I thought it would be easier to read and write about. The big city. While I was living at home and finishing my degree, I continued working at the ceramic studio, but the hours were limited and I wasn't saving any money. At the time, I had a girlfriend from Vermont who was living in New York City while she was going to school. I took the train down to visit her, and what started as a long weekend turned into me living in New York City with her for the next 4 years. The first was an unpaid internship at a hedge fund, and they told me I was not qualified to work for them, even for free. The second internship I applied for was at an architecture studio, and I got the job. It was a small firm, which meant I ended up doing a lot of different things. I managed a construction budget, I worked on their website, I visited contractors, invoiced clients, I helped get permits from the Department of Buildings, and so on. I worked there for several years, and eventually I thought that maybe I could start my own business along the same lines. But around this time, I felt a pull back to Vermont. I'd go back on the weekends, and the contrast was sharp between the pressure of Manhattan and the rolling hills of Vermont. This was also a difficult time because the panic attacks increased. It didn't help that my boss, the studio owner, was your classic New York City jerk. Super rude, super entitled, and a screamer. Monday mornings often began with this guy yelling at his wife, the employees, and the contractors. By this point, my girlfriend was tired of living in New York City and she decided to move back to Vermont. It was hard enough to make ends meet in the city, and if she left, I'd have the entire rent on my shoulders. So we both moved back to Vermont, and I continued to work at the architecture studio, but remotely. After a bit, my girlfriend and I parted ways, and I was back living at my mom's house, now in my mid-20s. In 2009, when my sister turned 21, we each got $100,000 from my father's estate. That money had come from when he and my uncle sold their mother's house in Hanover, New Hampshire in the early 1990s. I wanted to invest at least part of that money. The problem was that aside from Ben's cool 16 grand and my limited experience with large cap stocks, I didn't know how to invest. I moved into a small farmhouse not far from my childhood home, and I got reacquainted with a girl that I'd known in high school. About a year later, we got married. The New York job, although remote, remained stressful in terms of interacting with my boss, and after one of his bigger outbursts at me over the phone, I quit on the spot, and now I was unemployed. I had already been focused on investing the money my father left me, but I was using a financial advisor. The results were far from impressive, and despite the poor performance, I was still paying fees to the advisor. I thought maybe I could do better than the investment results I'd seen thus far. The good news was, now I had some money available to get started. The bad news, I had no idea how to manage that kind of money, especially given my new job status. Backing into a decision. I had some thinking to do. I was only 24 and I had $100,000. If I played my cards right, it seemed that that would go a long ways towards creating a good retirement nest egg. Could I maybe put it in nice, safe investments that paid dividends and would not blow up? The recent subprime mortgage crisis put a huge dent in the American economy, and I needed secure investments. But a dividend of 2.5% on the entire $100,000 would only equal $2,500 a year. That was a non-starter. When I was living in New York City, I'd been making $45,000 a year, but the costs of living in the city were so much higher than in Vermont, I figured if I could gross $1,000 a week, that would be pretty good living for Vermont. Okay, so $1,000 a week meant roughly $50,000 a year. I've got $100,000 to work with. What am I going to do to get there? I might be able to find junk bonds that paid 15 or maybe 18%. That would get me part of the way there, but how would I make 50% per year? And then I thought about my friend Ben. As a mere kid, he scored $16,000 in the penny stock market. Now I don't know what he started with, but it was probably less than $5,000. And he was able to triple or maybe quadruple it in short order. If I could start with that amount, maybe $5,000, and do a Ben type trade just 3 lousy times in the whole year, that'd be $45,000. And I knew a whole lot more about trading now than Ben had known. That seemed like logically what I needed to do in order to turn that inheritance into something sustainable. In hindsight, working backwards like that is probably the worst thing you can do as a foundation for day trading. You should want to explore through the genuine curiosity of learning about it, not from the pressure of putting food on your table, because it did feel like a tremendous amount of pressure on me. But it also seemed like a prudent calculation at the time. I was fine with staying at home and learning everything I could about trading. But that was not my wife's idea of fun. She wanted to travel and she didn't want to scrimp and save. A penny here, a penny there. To follow in Ben's footsteps, I began my new endeavor by Googling penny stocks. There were plenty of websites dedicated to hot penny stocks. Talk about hype. Everywhere I looked, I was told about stocks set to take off or were rated as strong buys. Stocks that would disrupt the trillion-dollar sports industry or that were wildly undervalued. What pretty much all of them did was tempt you to put your email address or cell phone number in, promising free alerts to the next big mover. Many of them had countdown clocks on their sites showing when the next amazing tip would drop, if you signed up to get it. Once you signed up, 2 things were likely to happen. First, you'd get a steady stream of, quote, hot tips that the website was paid to promote. Second, they'd sell your contact information to many other services. In no time at all, my inbox was flooded with hot penny stock alerts. I signed up at a lot of these sites, plus I joined some forums and message boards. And like most things on the internet, a few were well done with useful information, but most of it was useless. It didn't take long to see which was which. Eventually, I settled on a handful of sources for stock information, and I actually had a little bit of beginner's luck. I'd get the email alert for a hot penny stock, I'd buy a stock, and I'd sell it for a small profit. But with other tips, I lost money. It didn't take me long to get frustrated. First, I felt like I was 100% dependent on waiting for the next alert. And then when I got it, I had to act immediately or I'd miss the action. The second frustration was with some of the, quote, premium alert services that I joined. They seemed to be run by successful investors, and they reliably sent email and text alerts for the trades that the head of the service was taking. They might even provide a watch list of stocks. But the problem was there was this huge disconnect between their results with the stocks they traded and a beginner trader like me developing a process for actually figuring out which stocks to trade. How did they find that stock? Why did they get in? At what price did they get in? It was especially frustrating when there was no news about the stock, but it was purely a, quote, technical reason for the recommendation. What I soon realized is that these services wouldn't teach you to develop your own strategy because it would be bad for their business model. As soon as you became independent, you wouldn't need them anymore. So they kept you guessing when it came to finding stocks to trade. They were handing me a fish in the form of a buy alert, but they were not teaching me to fish. I clearly had a lot of learning ahead of me. I initially put about $5,000 into an E-Trade account, but I almost immediately got what's known as a PDT notification. The Pattern Day Trader Rule, or the PDT rule for short, is a designation from the Securities and Exchange Commission that applies to traders who make 4 or more day trades in their margin account over a 5 business day period. A day trade is when you purchase or short a security and then sell or cover the same security in the same day. More on this later. The bottom line was that with my $5,000 account, I could only make 3 day trades in any rolling 5-day period. If I raised my account value to above $25,000, the restriction no longer applied. So that's what I did. And in my first year of trading, I made around $30,000. On the one hand, I came up short against my $50,000 goal, But I felt pretty good about the year because it was proof of concept that day trading could work for me. It was my first year of dedicated trading and I was green. As a side note, if a trader makes money or loses money in a day, it's usually called a green day or a red day. The same is true for red weeks, green years, and so on. I felt like I was close to really turning the corner. This will just keep getting better, I thought. Only it didn't. In my second year, I lost everything I had made in the first year. On the one hand, I was break even after 2 years. Not terrible. But as I went into my third year, I continued on the trend of having small green days and large red days. At this point, I was red on my endeavor to be a trader. To make matters worse, I had spent the profit that I made in my first year on my cost of living. And my continued expenses each month in year 2 and year 3 were now eating away at my trading account balance. My account was now down to the minimum required to day trade of $25,000. It would frequently dip below $25,000 and I'd have to add a little bit of money to get the account back up above that level so I could keep trading. I also was accumulating credit card debt just to cover my cost of living. It was the one-off expenses that kept adding up. I put my dog's emergency vet bill on the card, a repair of my card on another, a trip to a friend's wedding on yet another card, and I charged these expenses so I wouldn't have to take the cash out of my trading account, thinking I was just about to turn the corner and very soon I'd be able to pay off those bills. But I kept falling further behind and the interest rates didn't help. Now, it wasn't like I had taken that $100,000 from my father and blown it all on man cave toys. I had been careful with the money. Still, I felt like an idiot, a total failure and a disappointment to my father. All I had left of his money was the $25,000 trading account balance. Double barrel emotions. There I was, the guy with regular anxiety attacks, and to that I added regular bouts of guilt at losing most of my dad's inheritance. I was in year 3 with 5 credit cards each maxed out to nearly $30,000 in total debt and only $25,000 in my trading account that I just couldn't seem to grow for the life of me. I was up against the ropes. I was deeply engaged in trading and I wanted to extend my knowledge and turn that corner. But at the current rate, I was going to run out of runway before taking off. That's when I thought seriously about getting a regular job, like working a 3 to 11 shift at a local ski area with my friend David. I also thought about every way to lighten my expense load. I could increase the deductible on my home insurance. I could downgrade or eliminate subscriptions to our cell phone plan and Netflix. And I had no problem cutting firewood for my wood stove so I wouldn't have to buy another tank of home heating oil. Out to lunch. I had gotten myself into this financial bind. I had not only invested myself in stocks, but I'd invested myself in the form of knowledge about how to trade. I was willing to work hard to turn the corner. And I was also willing to tighten my belt financially to buy more runway so I could finally reap the rewards. But my wife at the time was not on board. She wanted a husband who could take care of her without needing to cut back on spending. She didn't want to choose between taking a vacation or giving me a few more months to focus on getting this new endeavor off the ground. Why don't you get a real job? She'd say. All my friends in New Hampshire are real men, unlike you. They work in construction, they're painters and electricians, and look at you. You're trying to make money in the stock market, and what do you have to show for it? You're a loser. Following the Great Recession of 2007 through 2009, many people had a deep loathing for the big Wall Street banks that brought the financial system to its knees. I think she fell into the belief system that Wall Street and the big banks were evil. It wasn't that I disagreed, but I was the little guy. I was trying to make a little money off Wall Street while living in my farmhouse in Vermont. In any case, not long after that conversation, on a Tuesday afternoon, she said, "I'm going to lunch with some friends." And I was like, "Okay, that's fine. I'll see you later. I'll be here studying charts." Except I didn't see her later. She never came back. All her stuff was in the house as if she was going to lunch, but she never came back. At first, I thought something terrible might have happened. I had no idea what was going on. She wasn't answering her phone. I couldn't get a hold of her. This was crazy. And then we spoke. She said plans had changed. She was with some friends and she'd be home later. Except she didn't come home later. I'm thinking maybe she just needs some time to unwind and cool down. After all, our situation isn't that bad compared to other people, all things considered. But she never came back. 3 weeks passed and I called her. I said, "I don't know what to do, but this is crazy. If you don't come back by the end of this week, I'm going to file for divorce." She didn't come back, and that was actually probably a good thing. She wanted to live a lifestyle I couldn't provide. She wanted me to work her idea of a regular job, and I didn't want that. And she wasn't willing to get a job herself. After turning that page, I doubled down on reducing my expenses because now it was just me and my dog. I cut firewood, I cut every expense I could, I made Craigslist ads for stuff in my barn, stuff I really didn't need. And through all of this, I was able to buy myself some extra time and extend that runway. Wanted Guru. Now that I was back on my own, I could really take immersion learning to another level. I continue to look for sources of information, not just on what stocks to buy, but why it's a good buy and when to buy it. I found some well-regarded services, but usually they gave advice about mid-cap or large-cap stocks. I'll explain more about mid-caps and large caps later on, or you can look them up at the glossary at the end of this book if you want to know right now. The other issue is these sources might explain why they liked the stock, why it was the right time to get in, but it was a swing trade, not a day trade. A swing trade is where you hold a stock for days or weeks versus day trading where you don't hold anything overnight. With my account, I couldn't afford the risk of holding a stock overnight. If I held overnight, there could be news of a secondary offering or another big event where the stock could literally drop 40 or 50%. I couldn't take that kind of risk. I discovered another source of information, colloquially known as a squawk box. In the old days, this was a type of public address system in brokerage houses, tied to Wall Street information sources. It later morphed into online chat systems among institutional traders. Institutions are places like pension funds, big banks, brokerage houses doing their own trading or trading on behalf of big clients. The squawk box chatter was stuff like, quote, "My source at Goldman told me they're looking to unload a big position on Apple," or takeover talk on Alibaba. Or it might even be something absurdly cryptic like Apple with 3+ signs. Maybe it meant something to a guy in suspenders chomping on his fat cigar at the Morgan Stanley trading desk. But it had zero value to me in terms of what I could buy with that supposedly hot information. In the course of all this searching, I began to focus more on traders that were day trading small cap stocks. I learned about the tools they used, like the gap scanner and the high day momentum scanners, more on those later. But I never did find someone who was a real mentor to me when I was getting into this business. Instead, it was a slow process of looking around at what was on the internet and signing up for mostly free services. Pretty soon, I had a fire hose of information pouring into my email and phone from all sorts of services that bought and sold my contact information. I deleted most of them, but I tried a few. This must have been what prospectors felt like during the gold rush. You hear some people found gold, and suddenly there's no shortage of tips about sure things. You know that most of them will literally not pan out, but some just might. So how much of your time and money do you spend chasing these leads? How much do you invest in tools, like prospecting gear, or in my case, software, to locate the next pockets of gold? 2 steps forward. I continued to trade and learn, and I had periods where I traded well and I'd make a little money. Then I would give it back and try to make that money again. It was the classic 2 steps forward, then 2 or 3 steps back. Every 6 to 8 weeks, I'd think, oh man, here we go again. I might make around $1,000 a week for a nice consistent run of 8 weeks. And then I'd give it all back in a $10,000 loss in one morning. Many times those trades were impulsive losses that spiraled quickly into what I called snowball days. Then I'd have to regroup, get back on the horse, and rebuild again. The next crisis came when I took a loss of just over $5,000 at the beginning of a new month. It was August, summer was almost over, and that loss dropped my account down from just over $25,000 to about $19,500. I wasn't going to be able to trade in that account until I funded it with more money. My account was offline. I felt completely defeated. I walked outside, I sat on a stump in my woodshed, I put my head in my hands. What was I going to do? I needed a game plan. And I needed a trading plan. And I also needed $5,000. Down to my last idea. I'd been trying to absorb ideas from other traders and online communities that I hung out in. During the time my account was offline, I had time to think. One thing I believe I've always been good at is figuring stuff out instead of just throwing the whole thing out the window. I enjoyed video games growing up and Sudoku puzzles when I was older. Trading felt like a real-life puzzle. I was at a roadblock on solving this puzzle, but I was not ready to give up, not even close. I had an Excel spreadsheet of pretty much all of my trades. Part of the reason I kept those detailed notes was because of the relationship I had with the money that I was tracking that my father had left me. I felt like I needed to account for every gain and every loss, even if only to myself. The information consisted of things like the trade date, the amount, the stock I traded, how much I made, how much I lost, what the pattern was that I saw, why I made the trade, and just overall comments. One useful perspective that jumped out to me was to look at the components of my overall performance. True, I had given back my first year's gain in the second year, but I had made tens of thousands of dollars in gains. Yes, they were offset by a similar amount of losses, but my trading had indeed been working well, at times. Just as traders study the movement of a stock in order to see patterns, I studied my own trades. By this point, I had lots of data in the form of those positive and negative trades. What was I doing differently when I made money from when I lost it? It can't be random. What was the pattern? What did the winners have in common? I discovered 5 common denominators. First, I realized that I had performed the best on stocks that were up over 10% versus the prior day's close. For example, if a stock price at $8 yesterday was trading at $8.80 or higher today, that would be up 10%. Second, the stocks that I did the best on always had high volume relative to how many shares usually traded in a single day. This is called relative volume, and it's measured as a ratio of today's volume versus the average volume for that stock. A stock that had 10 million shares of volume today, but typically only trades with 1 million shares of volume per day, is trading with a relative volume ratio of 10. Third, on higher priced stocks above $20 a share, I had outsized losses. Now I would have winners too, but overall I was losing more than I was making on those higher priced stocks. I attributed this to the larger ranges higher priced stocks will trade in, and how easy it is to take a quick loss that far exceeded my anticipated max loss on the trade. By eliminating stocks priced over $20 and focusing primarily on stocks between 2 and 10, but certainly not more than 20, my historical data showed I actually would have been more profitable. Fourth, often the volume and the volatility was the result of some type of news about the company. Focusing on stocks with news seemed to eliminate a lot of the false breakouts and unnecessary losses. However, there were times that a stock could make a big move simply due to what's called a technical breakout or a short squeeze, where the stock performed outside the expected parameters and traders took notice. I decided that focusing on stocks with news would be better, but eventually I might be able to trade stocks without news if they proved they were strong and met my other criteria. Fifth, I realized that the stocks most likely to go up not just 10%, but 30% or even 50% or more in a single day had a very limited number of shares available to trade. This is called the float, and lower float stocks are more volatile than ones with a higher float. When a company does an initial public offering, or an IPO, it sells a fixed number of shares onto the market. Following an IPO, a company can do a secondary offering to sell more shares. This is a form of dilution and generally reduces the price of the stock. Companies can also conduct share buybacks or reverse splits. Both effectively reduce the number of shares available to trade. As an example, when GameStop made its meteoric rise, it already had sold about 69 million shares onto the market. This represented the float of the company. On the days when the stock traded over 100 million shares of volume in January of 2021, there was so much demand that as soon as somebody sold shares, another person was ready to buy them. With limited supply and massive demand, the stock price continued to surge higher. It's unlikely that this would have happened if the float on the stock had been as large as, say, Bank of America, with an 8 billion share float. As it turned out, the first 4 discoveries, the first 4 common denominators, 10% change on the day, high relative volume, breaking news, and the price between 2 and 20, were all based on criteria that create a high level of demand. The 5th, float, is based on supply. High demand and limited supply creates an imbalance which can lead to momentum and volatility. This is what real day traders are looking for. I just can't believe it took me this long to figure it out. It all comes back to supply and demand. Up to this point, I had tried a little bit of everything. I had traded stocks like Apple. My thought at that time was that it was a good idea to get to know one stock really well. So why not take an iconic stock like Apple, which, after all, had made fortunes for many investors before me? But unfortunately, they were really only profitable in the rare occasions that the underlying asset made a very large move. This was too inconsistent to be my bread and butter strategy. I had tried penny stocks, but unlike my friend Ben, I found the losses were larger than the gains. Penny stocks weren't a consistent way for me to make money, and they forced me to be 100% dependent on trade alerts. I also tried small caps. Small caps are relatively small companies, as we'll discuss in a later chapter. Most stocks under $20 are considered small caps, and it turns out I found success in this area. I just hadn't realized it before because I'd spent 2.5 years trading a little of everything. Trading a little of everything can be good early on because you'll discover which strategies match your risk tolerance and your personality. Unfortunately, in my case, trading a little bit of everything at the same time with real money caused real problems. It made it difficult to realize that while I had been losing money overall during my second year, one strategy I'd been trading had quietly been outperforming all the others. With new insights into my winners and losers, I created a plan for getting back on track. A solution to the puzzle was within reach. I decided to stop trading Apple and the other stocks that had super high ownership by big institutions like mutual funds and pension funds. After all, these stocks rarely had high relative volume and were rarely up more than 10% in one day. To be honest, when I traded those stocks, I felt like I was trying to play chess against a supercomputer. And I wasn't wrong. I later found out that most of the volume in these stocks is actually generated by high-frequency trading algorithms and computers run by institutional trading firms. On those stocks, I have no edge. Cutting out large caps meant I could cut out options trading too, because I only traded options on large cap stocks. And I could also eliminate penny stocks because I found I was consistently losing money on stocks under $1 a share. Based on my self-analysis, my best trades were on stocks up over 10% with high relative volume, some type of breaking news, and price between 2 and 20, and with a float of less than 50 million shares available to trade. I could more easily see trading patterns on those stocks. But certainly, no stock has big days every day. That meant I was going to have to get comfortable trading different stocks every day. But if I used those 5 filters, I could quickly get a sense of which ones looked like they might have a big day today. Although there will always be some exceptions, such as trading GameStop, which was over $20 and with a 69 million share float. When I was at rock bottom, I couldn't afford to deviate from what my metrics were telling me. I needed to systemize my trading. I needed to take the emotion out of my trading. And it was time to check myself in to trader rehab, which you'll hear more about later. Though my back was up against the wall, I was now armed with a real trading plan based on my own historical data. This strategy was not based on stock alerts from penny stock newsletters or from one of the hundreds of trading gurus out there blasting text and email alerts. Though my back was up against the wall, I was now armed with a real trading plan based on my own historical data. This strategy was not based on stock alerts from penny stock newsletters or from one of the hundreds of trading gurus blasting text and email alerts, but instead on solid insights based on when I actually was making money from trading. This is the blueprint I wish someone had given me when I got started, but at least I had it now. Better late than never. Now I still needed $5,000 to get my account back up above the $25,000 PDT minimum. A few years earlier, I had bought a fairly rare European import Mercedes with a manual transmission and a diesel engine. It had been left to rot in my friend's yard, and he let me have it for $350 as long as I could get it out of his yard. I fixed it up with new brakes, new calipers, all new suspension, and new paint. And during that project, I bought a second Mercedes of the same vintage era for spare parts. I loved those cars, but I needed the money. And now, with a trading plan in place, I felt confident in my decision. I listed the cars for sale, I sold them both, and now my account was back above $25,000. This was my last shot. I was up against the ropes, and I didn't have much left I could sell if I lost another $5,000. Discipline. I knew what I needed to do. Now I just had to execute, and that was by no means a trivial task. I was asking myself to change my behavior on a dime. Trading discipline was something I had struggled with from early on. Even before my new insights, I had known about how trading was an emotional roller coaster and how there's certain behaviors I needed to avoid. I created a set of rules to try to prevent blowups. Even though I had tried to be disciplined in my first 2.5 years of trading, on some days, I'd basically break all the rules I had set for myself. I would be green, and then I would give back half my profits, and I'd keep trading. I would hold way past my max loss on a trade and just hope it would bounce back. I would average down on a trade, which is adding to a loser. I would trade past the maximum daily loss amount that I'd previously set as a boundary. I'd trade even after having 3 consecutive losers, a red flag that should have told me to stop. I'd revenge trade when I'd try to make up for previous bad trades by jumping prematurely into another position. And then I'd get furious at what just happened to the last trade and would FOMO in long at the top. FOMO is the fear of missing out. And I'd buy at the top when the signals told me not to, just in case it was going to go higher. In short, these are symptoms of emotional hijack, and I would literally pay the price. I was bad at walking away when I was having a bad day, and it was costing me a lot of money. This was the reason that I would have 8 or 10 good weeks in a row, and in one day, I'd give it all back. But now is different. Now I had no choice but to be disciplined. If I wanted to avoid pumping gas or working a 3 to 11 shift at the ski area, I need to follow my own rules. I had to go cold turkey on my emotions, set firm guardrails for my trading, strap myself in, and do what I knew. I'd come to learn one other thing about trading. Successful traders do not trade for 10 hours a day. The focus and discipline to be on, to be watching a stock, second by second, intently, simply could not be done for 10 hours a day. Sure, anyone can sit like a zombie and stare at monitors for 10 hours a day, but that's not what professional day traders were doing. So I set myself a limit to trade for 2 hours a day in the morning. Then I would go outside and split firewood. After all, I needed to get ready for the winter because I was not going to be buying that home heating oil. After I finished stacking enough firewood, I decided to paint the house. It wasn't so much for aesthetic reasons as it was to preserve my house investment. Besides, the farmhouse was white and a few cans of white paint didn't cost much versus the trading losses it was preventing. So I got into a nice routine and I kept myself busy and I felt very productive. In fact, it almost felt like therapy. I was in control of my tiny little world. I had my strict window of trading, during which I followed equally strict rules about that trading, and then I would get off the computer. To be clear, I shut off my computer and unplugged it. There was even a period where I'd put my computer in the car. Anything to prevent myself from opening that computer again and looking at stocks for the rest of the day. I knew that people who wanted to watch TV less would take the batteries out of the remote and put them in a drawer in the other room. And I similarly made it hard to look at stocks once I'd finished my trading session. I could do more wood splitting, scraping, or painting, but what I could not allow myself to do was open that computer again until tomorrow. I developed my mantra: get green and shut it down. In other words, I could trade in my 2-hour window, and if I made a profitable trade according to my new criteria and I was green, I'd shut it down and walk away. If my first or second trades were red, again, using my criteria, I might trade again if I saw the right pattern. But as soon as I got green, my 2-hour window was over, or I hit one of my rules to stop trading, whichever came first, I shut it down. Tightrope. My guardrails were so tight, it felt like I wasn't on a highway or even a narrow trail. I needed to walk a trading tightrope. I could not afford to make many mistakes, but that was what I needed. There were some days when nothing set up. That is, nothing matched my previously successful trading pattern or, quote, setup that I was hunting for. On another day, if I clearly saw my setup, I would trade it with what at the time was fairly big share size for me. When I saw it clearly, I was going big. Get green and shut it down. If I didn't see it, I wasn't trading. This was a major turning point for me. I had been through a multi-year process of experimentation, journaling, and reflecting on the few things that worked and mainly the things that didn't before I finally started to turn that corner that I felt like I'd been close to for so long. I'm convinced that one of the big reasons I did eventually turn the corner was because I stuck with it for as long as I did. Lonely as it was, I no longer had someone continuously telling me I was an idiot and I was wasting my time on the stock market. I eventually unsubscribed from all those hot tip services that simply created dependency on the next alert. I started to be able to go to my little stretch of stream, to my fishing hole, and patiently wait. Some days I caught nothing, but at least I shut it down after a couple hours. I also didn't chase up or down the stream, listening to others who claimed that they'd hooked a big monster fish and it got away. Other days, I caught a fish and I promptly packed it up. I wasn't getting rich, but I was getting green on a decidedly more regular basis. 2 years of work. It took me a solid 2 years of studying, testing, failing, and refining to turn the corner and emerge on the other side with a small but powerful set of trading principles. The first one was what I already mentioned: get green and shut it down. The second one, which allowed me to find that fishing hole and start being somewhat successful, was to focus on the gap scanner each day. This stock scanner showed me which stocks were set to open the highest relative to where they'd closed the previous day. This is super important to look at each day for one simple reason that you'll hear me keep coming back to again and again. You need to watch the scanner because a huge number of other traders are also watching it. Traders flock to the top 10 gappers each day. Elsewhere in this book, I'll talk about other popular tools and metrics that many traders focus on. Think about just this one simple measurement: top gappers. Let's say you're really intrigued with a particular stock and you want to analyze it in depth before deciding to invest in it. Here's one way to do it. You'll scrutinize all the financial filings the company has ever made with the government. You'll set up a Google alert so you'll be notified whenever the company issues a new press release, a social media post, a YouTube video, anything about the company's activity. CNBC will always be playing in the background near your desk so you can pick up any chatter about the stock. You run a bunch of financial ratios and other analysis to get a sense of perhaps whether the stock is likely to make a move. Perhaps you talk it over with your broker or financial advisor to see what that person thinks. You can do all that heavy lifting and more just to try to predict when a stock might make a move. Then again, you might be rewarded with a stock that doesn't go anywhere at all for a long time. Contrast that with finding out in real time what stock has just jumped up. The difference is gigantic between what might move, what should move, and what is moving right now. This brings me to the next key principle I began to follow. I wait for a stock to start to move and then I jump in. I wait for it to prove itself. Not that it'll necessarily be the next Apple, but that today it has the potential to squeeze up 20 to 30% or more. Now, I can imagine you saying, well, Ross, that sounds fine, but aren't you ignoring one key thing? By waiting for the stock to move, aren't you giving up on some of the upside? Yes, you are correct. By waiting for a stock to appear on the top gappers scanner, I've theoretically given up some of the upside potential because someone else may indeed have been in the stock before the move. But you know what? I am totally okay with that. Let's briefly return to the fishing analogy. It's well established that sometimes the fish aren't biting. If I wanted to, I could sit by the stream all day, every day, waiting for the fish to get hungry. Or I could pay some kid to sit there and only fetch me when the fish are actually biting. It's my stock scanners that are alerting me when a stock is beginning to move, and I am happy to pay for them. I consider it not as lost money, but as gained opportunity. Instead of parking my money in stocks hoping they might start to move, my account is sitting in cash until a stock begins squeezing. At that time, I execute my strategy, I trade what I see, and I follow my mantra of get green and shut it down. I have limited my exposure in the market, and if that means I made a little less than the person who may have been holding the stock for weeks or months, I am okay with that. Later, we'll get into the strategies I use for how long to stay in and what I do if I get out and the stock keeps going. But back to the gaps. I came to realize that there is a mentality in trading that when a stock starts to move, everyone wants a piece. There is a bit, and sometimes more than a bit, of a clamor to get some. Everyone wants a piece of the action. It's true that you're battling a little bit with other traders to get in before the next guy, so to speak. But for a lot of these stocks, I've found there's more than enough volume and enough trades for many small traders like me to participate. Wow, what a trader. In the course of my trading self-education, I chatted with a lot of people online about our shared interest in trading. I want to step back for a moment to something that happened to me about a year before I turned the corner. Around that time, I developed a friendship with another trader in one of those message board kind of chat rooms. He was doing very well, and we would chat about what we saw going on in the market. If you've not taken part in these sort of chat rooms, you might think that traders keep to themselves, maybe out of fear that they'll give someone a tip that'll ruin things for their own trading. But I found that there's more to be gained by chatting with the right sort of people than there is the risk that you'll somehow give away your trading edge. After all, we're the little guys. We're not Elon Musk who decides in one tweet one day that he wants to buy Twitter and the market moves. Anyways, every couple of days, one of us would contact the other and we'd sometimes compare what we had our eye on in the morning and we would talk while we were trading. I found that I was getting more and more frustrated as time went on. I couldn't believe the disconnect between my trading success, which was very limited, and his, which was impressive. It was year 2 and I was already out of beginner's luck. I was on a steady decline with 2 steps forward followed by 3 or 4 giant steps back. And this was back when I was still married and I felt a lot of pressure to turn things around quickly. I started to feel like this trader that I was chatting with was acting on my ideas with more confidence and faster than I could. Maybe he just had more conviction while I was hesitating. I mentioned my dismay at how much better he was doing, and he had an idea. He said I was helping him a lot, so how about we trade like a team? I could be the research and idea guy, and he would be the main trader. It sounded like a pretty good idea to me, so we came up with the idea of setting up a little company and funding it with $50,000. $25,000 each, 50-50. He said just send me the $25,000 and we'll split the profit at the end of each month. Now, if it sounds too good to be true, it probably is. And before I sent him the money, I did a little bit of digging. I found out the name he had given me was not real. Determined to get to the bottom of it, I was able to find his email address and his real name based on the few details he had shared in passing over our time chatting. When I Googled him, I quickly learned why he had given me a fake name. He'd been arrested before, and the articles about his arrest were the first thing that popped up. His name being on the National Sex Offender Registry appeared as a close second. I had been a couple of mouse clicks away from sending him $25,000, the last of my father's estate and money I could not afford to lose. Wow, that was close. I was left feeling that I couldn't trust anyone online. And this is one reason that I later formed my own trading community with the goal of creating a refuge from the unmoderated chat rooms where so many people hang out, including predators. Where's my money, Ross? I brought this up because fast forward to today, I regularly hear about scammers, and some of them pose as me. Someone will email me, Ross, what the hell is going on? Where's my money? I sent you the $1,000 in Bitcoin as you told me, so you could trade on my behalf. What's taking you so long? I'm sorry they were scammed, but think about it. I post my audited broker statements on my website. You can see me posting my recaps on YouTube most days. What's the likelihood that I'd be reaching out to people on social media, asking them to send me $1,000 so I could take a chunk out of my day to trade it? It's like those email spam campaigns where the widow of some prince wants to send you $13 million out of the blue. It makes no logical sense, but I bring it up because I came this close to falling for it myself. I don't want you to get as close as I did, especially with anyone who would pretend to be me. The Holy Grail. I had turned the corner and I was regularly seeing green days and green weeks, but I was not done refining my approach. Because I had limited myself to a short window of trading each morning, I had a lot of time during the day to think while I painted the house, chopped wood, and whatnot. I had come across some software that allowed for automated trading. You could script or code a strategy and it would trade it for you. That seemed to me to be very cool. I mean, my problem early on had been sloppy, emotion-driven trading where I didn't stay within my strict parameters. Well, computers are all about following detailed commands. I could tell a computer to follow all the parameters that I wanted and it would never deviate from that set. This was the ultimate way to take emotion and inefficiency out of the equation and in effect have the Terminator do my trading for me. I could program in many criteria, like percentage change on the day, volume relative to a stock's average volume, the price range I wanted to trade, for example, under 20, but not less than $2 a share, the total volume, the rate of change, the volume in the last 5 minutes, the number of cents it's moved up in the last 5 minutes, the spread of a stock. We'll talk more about that later. I thought I could tell the system to scan all stocks all the time, and if it found one that met my criteria, Then I could direct it to place an order for a certain amount of shares, use a 15-cent trailing stop. Again, don't worry about the jargon. I'll explain more about that later. And this would be amazing. What was really cool about this system was that it allowed me to take my trading parameters and see how well I would have done if that system had been in place for the previous 30 days of real trading activity. This was sort of an insurance policy. I might think that my parameters were good, but how well would they have really done if they had been in place during the last 30 days? This application of rules to historical data is known as backtesting. I backtested my set of rules and was like, wow, okay, over the last 30 days, if I was trading this set of rules with 1,000 share orders, I would have made $20,000. This was it. Yes, it was a lot of work to refine this criteria, but after I did it just once, I'd be able to rely on the computer to faithfully and perfectly execute my instructions. No complaints, no sick days, and no forgetting about my explicit commands. This was the Holy Grail. It's too bad the real world is different. I tested my new system, and I discovered that the backtesting was one thing. The actual trading was another. Backtested results captured a few details about how the market performed, but they did not record the extraordinary complexity of the minute-by-minute market. It's as if the backtesting showed you a video of black and white, and then when you ran those commands in the real world, you were seeing a million shades of color. I discovered that slippage was the biggest variable. Slippage is the difference between the price you want or expect to pay when you issue a command to buy 1,000 shares now, and the actual price that you pay for the trade. The backtest results didn't factor any slippage on entries or exits. But in reality, on many of the trades I was taking, I was getting a lot of slippage. The reality of the stock market is it's like a flowing river. You're standing there in the river with your fishing rod. You cast the rod intending to land your hook and bait in a certain spot, but you end up being a foot south of the spot you were looking at. That happens with the stock market, believe it or not. Humans operate in intervals of days, hours, minutes, and seconds. But the stock market operates in intervals of milliseconds, 1,000th of a second, and microseconds, 1,000,000th of a second. What most people, including me, at least back then, don't realize is that stocks can trade in microseconds. That means if a trade gets executed just 14 millionths of a second before my trade, I could pay a higher price on my order. I discovered there was another reason my carefully crafted set of criteria did not work as I expected when I let it loose into the real world. It was possible that my buy order for 1,000 shares was not executed at all because the market jumped over my order. And that was the case with some of what would have been the best trades during that 30-day period. So when you factor in slippage and you take away a few of the best trades, that was the difference between success and failure of automated trading. Alas, I thought I had found the Holy Grail where I could tune and refine my strategy so that the robot system would follow my exact instructions. And although it did indeed follow the instructions, it was far more complex and chaotic a system than I expected. I was trying to play on the same field as the big boys at Goldman Sachs, Morgan Stanley, and Citadel. Except they hire brilliant physicists and mathematicians and spend hundreds of millions of dollars to create their high-frequency trading algorithms. Those systems do extract billions of dollars of profit from the stock market each year, but I can't play in the big leagues. I don't have the experience or the money to hang with them. And although that was the bad news, I realized there was also some good news. I could still play the game and win. I just have to be content with doing it on my own at the rate of 2 hours a day. That thought gave me some peace of mind. I'll let the giants clash overhead and compete for the billions of dollars at stake in the market at large, and I'll be content to compete where the stakes were, first, my cost of living, then a nest egg, and if I played my cards right, maybe a few $1 million in the bank. My big dreams don't even register as a blip on the screen of the big boys, and that is fine with me. Thinking out loud. I earlier mentioned that I've come from a long line of teachers, and teaching seems to be in my blood. I like to share what I know, and I also get a sense of clarity from putting my thoughts into words. Throughout my early years in the market, I had gotten into the routine of answering questions beginner traders were posting in online day trading forums. I rather enjoyed the focused isolation of my solitary life in Vermont, but I also found energy in discussing day trading with others in the forum who were as passionate about it as I was. During this time, I decided to fence off a little corner of cyberspace that would be dedicated to day trading. I created a website, which was a fun and easy side project given my prior experience building websites, and it became a bit of a digital journal where I documented the ups and the downs as I was learning how to trade. I also wrote articles based on common questions I would see beginner traders ask. Like many of the websites I'd created for myself in the past, I had no business plan. I didn't even really quite realize it at the time, but I was building a sort of centralized database for everything related to day trading, from terminology to chart patterns to detailed explanations of hotkeys and order routing. I had never found a resource with this sort of focus just on day trading when I was starting out. Even though my website was new, I began to rank well in Google for very specific keywords like momentum day trading strategies or bull flag patterns, and that led to people finding me and engaging with my site. I then decided to point an inexpensive camera in my direction and hit the record button while I was trading. I uploaded the videos to a new YouTube account and I embedded them on my website. It never felt like work to do the blog posts or make the videos because I was just talking about the stuff that I was already passionate about. And this type of exposure also didn't trigger any panic attacks because I was in my comfort zone while I was working. Pretty soon it became clear that others shared my passion about trading and I began to develop a following. I always responded to questions and comments, and I noticed there were a ton of questions about the tools and the platforms I was using in my own trading. Soon I realized I could earn some affiliate revenue by providing a special referral link for people who bought some of the same tools I was using. Even better, people who bought with my special link would typically get a discount of their own. I liked this model a lot because it didn't cost my viewers anything extra for me to earn the affiliate income. I was not pushing any products on anyone. The concept was, here's what I use, here's why I like it over the alternative. You're free to ignore my opinion and use a different tool, but if you decide to buy it, feel free to use my link below and it'll probably save you 15, 20, maybe 30%, and I'll earn a small commission. I got a trickle of affiliate revenue, and then a bit more. Now my goal was to make $1,000 a week in trading profits, but with a small but growing following on social media, I thought it would be amazing if I could get to $1,000 a month in revenue just from the blog. That would give me a week's worth of trading cushion every month. It was a great feeling that even when I was having a bad day, I didn't have to freak out because I had this little bit of affiliate revenue coming in regularly. Upward spiral. Not only had I turned the corner, but I was picking up speed. My trading was getting more and more consistent and my affiliate revenue was growing. By 2014, I had generated enough visitors to the website that I created a free chat room. Naturally, this was a chat room dedicated to day trading. As the community of active members grew, so did the demand for me to be live broadcasting during the trading day. In order to upgrade the chat room features, I discontinued the free service and created a monthly subscription for a chat room membership. Later that same year, I taught the first edition of my day trading course. I taught that class on repeat once a month for over a year. In 2015, I wrote an earlier version of the book you're listening to today. It was designed to accompany the first edition of my day trading course. That book was more of a technical introduction to trading and didn't go into nearly as much detail about the steps you should take to determine if day trading was for you, or all the things you could do to minimize your risk and build your confidence. This book does all of that and more. During this period, I met a great lady, and after a while, we got married. She was from New York, and I was from Vermont, so we looked for a place to settle down that was roughly in between, and we settled on Great Barrington, Massachusetts. Today, we have 2 wonderful boys, and I have the dream setup. I can take part in this crazy, high-tech world of minute-by-minute, second-by-second trading, while looking out my window at the backyard filled with birds, chipmunks, and the occasional red fox. Throwing down the gauntlet. Over time, my blog posts and YouTube videos led to me having something of a following in the small cap day trading community. Over time, my blog posts and YouTube videos led to my having something of a following in the small cap day trading community. This following grew as I became more successful as a trader and as I produced more courses, more trading tools, and other information. One of the most common questions I got was along the lines of, it's cool that you've become successful, but the world has changed since you made the bulk of your money. How do you know your success wasn't a fluke? Other variations were more blunt. I'd like to see if you could make any money if you were essentially starting over from scratch, the way I am. I thought those were reasonable questions, The world is indeed filled with so much fake stuff, what with movies containing computer-generated action-adventure scenes, to outlandish claims on the internet, and so on. I think that sometimes there are people who will look for every excuse not to believe things. For example, there are still deniers about whether or not we actually landed astronauts on the moon, despite abundant evidence of the missions. But maybe you're one of those people who's not as cynical, but is merely skeptical or questioning, which in that case is good for you. Before you invest much time and effort into something as challenging as day trading, you should get your questions answered. Whole category of questions. I decided to see if I could grow an account from the minimum. As I mentioned earlier, you can't day trade in the United States with an account below $25,000 because you're severely restricted in how many transactions you can execute. However, several other countries have different rules and also have access to the US stock markets. It's possible to open a foreign account with as little as $500 and day trade in the US. I set a challenge for myself to trade with a tiny account. I deposited a little more than $500 in the account. After some setup fees and such, I had $583.15 to work with. I won't take you through the play-by-play of each of my trades during the challenge, though you can get more information from my audited broker statements on my website. But the big picture is that I began the account on January 1st, 2017 with $583.15. In 45 days, I had turned it into over $100,000. In 2019, I crossed over $1 million, and in 2022, I crossed over $10 million. I continue to trade in this account today. Though I'm proud of the result, it's important that you put this challenge into the proper perspective and understand that my results are far from typical. The fact that I did it does not mean anyone can do it. Even though I started with $500, it was not the first $500 I had invested in trading, and it was definitely not my first rodeo. You'll remember that I had literally spent years learning how to trade, and it was regularly a painful and humbling process. There is a certain amount of luck involved in trading. In other words, it's impossible to remove all the randomness. Therefore, I could have started the challenge the next day and it might have performed a bit differently. It's great if you're inspired by my challenge so that you can learn more about day trading, because that's why I did it. But as we'll discuss more later, it makes no sense for you to attempt to mimic the trades that I take on any given day. That's called mirror trading. And although many gurus and newsletter services will encourage you to blindly follow their alerts, I actively discourage the practice. What makes sense for anyone wanting to try to trade like me is to mimic the principles and the techniques I use in my trading, including the strategy, the tools, what to look for, problems to avoid, and so on. That is the whole point of this book. Takeaways. This has been a long chapter about how I got into day trading. You might conclude that I had some advantages that you don't have, like an inheritance from my father, and I won't deny that. Then again, it would be reasonable to conclude that I had some unique disadvantages in the form of my decidedly unsupportive first wife, my panic attacks, and no formal training in investments. Each of us is dealt a set of strong and weak cards. What counts is whether you decide to throw away the weak cards, get some new ones, and how you play that hand. Luck and skill will decide the outcome. What I love about day trading is how luck may always play a part, but there's nothing stopping you from working hard to increase your skills. In a sense, it's up to you to unlevel the playing field in your favor through what you learn about this great business. Guardrails. Earlier in this chapter, I described how I created a set of guardrails based on my experience and the urgent need to turn my trading results around. That concept was so important to my survival and success in this business that throughout this book, I want to describe those guardrails. Following them does not guarantee success, but I'm highly confident that if you learn about them, you'll have a valuable set of principles that may be useful to consider as you manage your own risk. I'm purposefully phrasing the guardrails as what I did or what I should have done, rather than suggest what you do, because I don't know your situation. I'll make the first guardrail be about the 5 common denominators I mentioned earlier in this chapter. They are the characteristics of the stocks that I have had the most success trading. Guardrail number 1, my stock scanning system for momentum day trading. I focus on stocks with the following characteristics. Number 1, up over 10% on the day versus the previous day's closing price. Number 2, high relative volume of at least 2. Number 3, share prices between 2 and 10, but not more than 20. Number 4, news, or some other catalyst is announced today. Number 5, relatively low float and therefore greater volatility. Certainly under 50 million shares and preferably less than 20 million shares available to trade. We're not quite ready to roll up our sleeves and learn the technical aspects of day trading. That's because we don't have a clean slate to work from. Instead, we have a bunch of preconceptions and misconceptions about day trading that can get in the way of learning how best to approach this business. In other words, we have a few elephants in the room. In the next chapter, let's do some elephant hunting. Chapter 3, Day Trading is a Scam. Did you know that only 9 cities in America have a population of more than 1 million people? Well, now you do. My YouTube channel has more than 1 million people, which kind of makes me the mayor of a pretty large city. As mayor, I get to deal with a certain number of lunatic citizens who make bizarre demands that will never be satisfied. They should probably move to another city. But by and large, I get a lot of great questions from our community. That's part of the reason I continue to run for mayor of my YouTube channel. I get questions that keep me on my toes and make me think in different ways. It's possible that a few of the following questions have crossed your mind. In some cases, you may not have a question, but a belief about what day trading involves. Either way, leave your rotten tomatoes at home and let's have a town hall where I'll give you straight responses to your toughest questions and remarks. Question 1. If it is possible to day trade profitably, why haven't the giant trading firms taken it over and monopolized it by this point? That indeed is a fair question, and here's the short answer. Day trading is small potatoes. There just isn't enough money in it for them. Let's take one savvy investor for example. Here's what a financial writer said about Warren Buffett. Warren Buffett and every other billionaire investor and institutional player is essentially banned from investing in the most explosive opportunities in any meaningful way. Let's say Buffett wanted to invest in a small cap company valued at $1 million. He could legally invest a few $1,000s and hopefully watch it soar to over 100,000 or more. But that would be a pittance for Berkshire Hathaway, which is a juggernaut valued at hundreds of billions of dollars today. A home run on a small investment won't move the needle for Buffett. His other option would be to invest more, say $500,000. But then he would own so much of the company, he would need to file a 13D schedule form with the Securities and Exchange Commission and take on the headaches that come with being what is legally known as a beneficial owner. The giant trading firms are no different. They're looking to make money from the largest opportunities, and no one is stopping them. For a firm with billions of dollars of capital to invest, day trading would be stepping over dollars to pick up pennies. Why bother trying to make a dime or even $1 a share when you can invest $250 million in Tesla and possibly return a $25 million profit or 10% in a matter of months in a well-timed position? Institutional trading firms have an undeniable edge in the market. They know better than you or I could ever know the inner workings of these Fortune 500 companies. They personally know executives and company owners as they mingle with them at social events. They have the best analysts working to predict the future prices of these companies. And the stakes are high with billions of dollars in assets under management. To help put this into perspective, let's look at a hypothetical day trader named Larry. He opens a $25,000 account and let's say he produces $100,000 in profit in 1 year by day trading stocks priced between 2 and 20 as they move up at least 10% on high relative volume. Of course, his performance is not typical, but I'm making a math point here. He's produced a 400% return against his $25,000 in starting capital. Well done, Larry. Now let's say that Larry has a very rich friend named Christina, and she wants to get in on the action. It's no problem for Christina to write a check to open a $25 million account, which she does. It is exceedingly unlikely, in fact, nearly impossible, that Christina will be capable of producing anything close to Larry's 400% return. That's because the small cap markets rarely have the liquidity to support a trader entering or exiting multi-million-dollar positions within minutes. Since Christina's account is 1,000 times larger than Larry's, in order for her to match Larry's 400% return, she would have to take the same positions as Larry with 1,000% larger positions. That means anytime Larry's buying 1,000 shares, Christina's buying 1,000,000. Unfortunately, as Warren Buffett and all the other big investors have learned, it's just not possible. Now, Larry has lots of room to grow his account because positions of tens of thousands or even hundreds of thousands of dollars can execute almost immediately. but Christina will have to take just a sliver of her account and day trade with it. What's great about the stock market is that among all the different sectors, segments, and financial instruments, there's room for everyone. Us day traders are the little fish relative to the big institutions, but we manage to coexist. Question 2 is more of a remark. Day trading is gambling, nothing more, nothing less. Anyone can open a brokerage account, fund it with a deposit, and start mashing the buy and sell buttons. Doing just this in the hope of getting rich is gambling. So let there be no doubt, some people gamble in the stock market, but that does not mean the profession of day trading is gambling. So the real question here is what separates the professionals from the gamblers? The closest legitimate comparison to day trading and gambling would be when we look at professional card counters at the blackjack table or professional poker players. Both are highly trained and highly disciplined people. They know with a fair degree of statistical confidence when to hold them and when to fold them. With strategy and discipline, they can actually push the odds of long-term success in their favor. Day trading is very similar in this way. Those who approach trading with discipline have a better chance of pushing the odds in their favor. And the beauty of day trading is that there are several steps that you can take affirmatively to reduce your risk. And by first reducing your risk, you can begin the process of developing a strategy and discipline in a safe environment. We'll cover this extensively in Chapter 8. Question 3. What role does luck or chance have in day trading? In Chapter 2, we talked about my friend Ben, who made a cool $16,000 in high school. That sort of trading is luck. And in his case, it was beginner's luck. That winner was not the accumulation of strategy and discipline. He heard something, placed a trade, and it paid off. But it was a fluke, as represented by the fact that he's not still trading today. I do think there is a certain amount of beginner's luck out there. I attribute this to the confidence that can come from being incompetent. It's the blissful ignorance of risk that leads to some beginner traders inadvertently taking high-risk positions. If they pay off, it's beginner's luck. I was profitable in my first year of trading, probably thanks in part to some high-risk winners. But then I gave it all back in my second year. So you can be lucky, but you can also be unlucky. As an example of bad luck, I was once trading at my farmhouse in Vermont and a tree knocked over a utility pole. My internet and power went out at the same time and there was no cell signal at my house. I had taken a position just before power went out and I was stuck. My laptop was still on battery power, but I was offline. No quotes. Panic. This could be very bad, depending on what the market did next. I jumped in my car and I raced down the road to an area where I thought I might be able to call my broker on my cell phone. I got through to him and fortunately the stock had not moved much. He was able to get me out of the position over the phone, and this is a story of a combination of good luck and bad luck, I suppose. From that experience, I learned a lesson. Always have my broker on speed dial and have multiple sources of internet or some type of communication. Today, I have both my primary internet and my computer on an uninterrupted power supply, and my cell phone serves as a hotspot for backup. Over the long haul, luck plays less and less of a role in day trading. Real practitioners tend to stay in business, and those who rely on good luck or hot tips get washed out. Question 4. If it's possible for regular people to make money, consistent money, by day trading, then why isn't everyone doing it? That's an easy one to answer. The reason is because most people are not cut out to be day traders. Many people who try to day trade come into the profession with severely inaccurate impressions about what it takes to day trade successfully. Some believe having a fancy financial background or exceptional intellect will make them more likely to succeed. Others think it's just a matter of hanging out on social media and jumping in the next meme stock. Even if everyone had an accurate impression of day trading, most people will not be willing to put in the time to get good at trading. And those who are willing to put in the time may not have the aptitude to be a successful trader. This is an appropriate time to go over the quote qualifications for day trading that are overrated or irrelevant. Then we'll talk about the real qualifications to be a trader next. Irrelevant belief number 1. I've been told more than once, I'm good at everything I set my mind to. It's true that successful day trading requires a certain level of self-confidence. You can't be second-guessing yourself while your finger hovers endlessly over the buy or sell buttons. But natural talent is overrated. What's more important is the willingness to put in the work and to stick through the inevitable, yes, inevitable, down periods. Sometimes it's the naturals who bail out the soonest, and the scrappy, tenacious bulldogs who end up being the successful traders. Irrelevant belief number 2, I'm great at math. This can be helpful, but it's hardly a guarantee. No matter how great you think you are at math, computers can calculate faster than you can. Traders can set up basically any kind of ratios and trend lines they wish and have them calculated instantaneously and in real time by the computer. So any natural mathematical gift is less and less of a competitive edge. Irrelevant belief number 3. Day trading should not be that tough. I have an MBA and I kick butt at reading financial statements. Congratulations on your hard work to get the MBA, but I have some bad news for you. Most of what you've learned is irrelevant to becoming a good day trader. In fact, it could even lead you down the wrong path. Here's what I've come to understand. Day trading is not about becoming an expert at the companies you will buy and sell. Day trading is about becoming an expert at human nature. You need to become an observer of investing emotions, both yours and those of other traders. Learning how human emotions of fear and greed translate into price action is critical to your ability to profitably trade the markets. You need to be able to capitalize on emotions in the market without falling victim to your own emotions. When you're looking at how a stock is behaving on an intraday basis, it's not the company that is the engine for the gains or losses. Sure, the company may have issued a press release about their quarterly earnings, a new revolutionary project, or bankruptcy. Those are all important headlines, but contrary to popular belief, it's not the news stories that change the price of the stock. Changes in the stock price are because of changes in supply and demand. Thus, changes in price are driven by active traders and high-frequency trading algorithms. A bankruptcy does not cause stocks automatically to change hands. What the news does is it affects the emotions of traders, who then act on fear, greed, suspicion, intuition, pride, and other strong emotions. Check this out. Researchers studied stock movements after big events. And in one study, they looked at the market movements after announcements of illness or death of US presidents. Following the news, the stock market instantly reacted negatively, but it tended to bounce back the very next day. The thing about that, on the bounce back day, the president was still sick or dead. So nothing had fundamentally changed. Instead, human sentiment had collectively shifted from pessimism to optimism. Let's look at it another way. Assume for a moment that you study the financial statements of a company and you go to great lengths to examine the senior leadership of the company. You don't stop there. You then talk to industry experts and analysts about the company's products and services and whether they're positioned to grow. Even with all that knowledge, a small cap stock has the potential to trade up 500% or 1,000% in the space of one day. Depending on how much you bought or sold on that day and exactly when you did so, you may have done splendidly, or you may have lost your butt. The same company, the same senior staff, the same products. As stocks squeeze up, they're experiencing massive amounts of momentum fueled by FOMO, the fear of missing out, greed, and speculation. These emotions fuel volatility. Exaggerated moves are often reversed as emotions swing from greed during the rise to fear during the decline. To be successful at day trading, what you need much more than an MBA is a Master of Human Behavior degree. We talked about 3 irrelevant things that people may think are qualifications, but that in fact will be of little help in day trading. So here's why day trading is not for most people. You need to pay the hard cost and soft costs of admission. When I say hard costs, I mean that you'll need to fund your account with a certain amount of money. We'll talk about your funding options in more detail later, but other hard costs include the purchase of your computer, external monitors, and the cost of courses, chat rooms, news services, and the software you may need. The soft costs are far more expensive. These involve significant time you will invest in learning how to day trade. Sure, nothing is stopping you from day trading on the first hour with your new brokerage account open and with no prior training, but that is a recipe for disaster in this business. Depending on how reckless you are with it, it could cost you far more than the money you funded your account with. Let's assume you're willing to learn. It's not like school where you might pull an all-nighter and pass the test. Here's what you need to do in order to be successful in this real-life school. First, you've got to learn a lot of the basic concepts and terminology. It takes work, but it's straightforward. Second, you need to understand the principles of how to manage your risk. This involves a set of principles you'll apply in different situations, and we'll talk about them more later. Third, if you're smart, you'll not risk a dime, but you will see how good you are in a simulator before trading with real money. We'll talk much more about using simulators later on as well. Fourth, with the results of trading in a simulator, you'll figure out what you're doing right, what you're doing wrong, and how to fix the mistakes you're making. 5, Once you're consistently doing at least okay in a simulator, that's when you think about using real money. But no matter how good you were in a simulator, you'll discover that trading with real money is a little different. Emotions start to pick up, so there'll be an adjustment phase. And these steps are only the beginning. You'll have a long period of learning, successes, setbacks, and adjustments before you feel like maybe you've got this thing called trading. Now consider all the steps I've just talked about. What amount of humanity do you think will stick with it until they're competent at trading? Yeah, probably only a teaspoonful. While the physical barriers to entry are low, the mental barriers are formidable. Now, I'm not trying to scare you off or paint a dark picture of the business I love, but I'm trying to be realistic so you have an authentic picture at the outset. If you want to learn a great deal about yourself and about how you think and behave under pressure, study day trading. If you want a graduate degree in human nature, both yours and the other traders you'll trade with, study day trading. It's the craziest thing. To the rest of the world, it looks like we're engaged in fancy-sounding activities related to high finance, financial markets, prospects for pharmaceutical advances. But instead, for the most part, we're anticipating what a bunch of other humans will be thinking, feeling, and acting on in the next 5 to 10 minutes. So if you're willing to pay a significant price in terms of time, money, frustration, and being humbled, you've come to the right place. Now, some of you might be thinking, no offense, Ross, but I have a hard time believing that you will tell me exactly the methods you use to trade. If you did that, wouldn't you lose your competitive edge? It may be hard to believe if you're not in the business, but as soon as you start learning about day trading, you'll understand why I can share everything without fear of being outcompeted. The stock market is like an amazing kaleidoscope of activity. Trades are happening even within one stock in literally microseconds of each other. National news, local news, company news is continuously washing over all of us investors. And on any given day, are there recession fears? What battles are going on in Congress? Is the Food and Drug Administration authorizing some new drug? Did war break out somewhere? The list is endless. The quote secrets that I try to emphasize relate to things like how to manage your emotions when you're doing great and when you think you're invincible, or when you've had a string of red days, think you know nothing and are ready to throw in the towel. How to continuously get better at recognizing patterns you've seen before, at seeing new patterns, and at ignoring the extraneous stuff. I like to emphasize all the ways you can manage the risk you're taking while you're trading, and how to know when to keep trading each day and when to shut it down. These are just a handful of my quote secrets, and I'm completely willing to discuss them at length because so few people take the time and effort to internalize them. Even if they do, there's more than enough profit in the markets to go around. Now, some people have a scarcity mindset, also known as zero sum. They think that if someone makes a profitable trade, someone else loses. I disagree. First, if I make money on a trade, I have no idea how long the person on the other side of the trade held that stock for, or what price they got in at. Second, the markets are a vast ocean of money, measured in many trillions of dollars. If you dip your spoon in the ocean, or even take a bucketful, it doesn't change the water level for the rest of us. Some of you might be thinking, Ross, I know you did a challenge in 2017 where you turned $583 into more than $10 million. I bet you can't do that again. After all, the world has turned upside down since then. For me, the hardest part of any small account challenge is making the first $25,000. Beyond that, it's not a matter of whether I can turn it into $1 million, it's just a matter of when. So why is that first $25,000 the hardest part? In a small trading account, I have zero cushion. If I start with $500 and I simply have the misfortune of starting with an 8 or 10 trade losing streak, there's a good chance I'll have to add more money to that account. Does that mean I failed the challenge? Perhaps. But trading isn't a sprint. It's a marathon, and I always get back on the horse and try again. The real reason I don't reset my account to $500 at the beginning of each month is because of the tremendous opportunity cost of trading with such a small account. It's simply not possible to make as much each month with a $500 starting balance as I can if I start with $50,000 or even $500,000, for example. For me, trading with a $500 account is really about proof of concept. Does this strategy work? Can I produce profit? It's not about doing the same thing over and over. Anyone perpetually keeping themselves at a $500 account by taking their profit out and resetting to $500 at the beginning of each month would be greatly limiting their upside potential. Now, I want you to think back to when you learned how to drive, if you know how to drive. You likely first studied a book about driving rules, and then you watched other people as they navigated different situations. All of this was vital to your preparation. But after a certain point, your next big learning moment came when you got behind the wheel. There's nothing quite like learning by trial and error. With learning to drive, trial and error is hopefully within the safe environment of a driving instructor sitting next to you, and hopefully it's in a parking lot and not in a super expensive car. The trading simulator is like the driving instructor, making sure you don't get wrecked. And trading a $500 account is like driving your first car. You'll make beginner mistakes, but the damage is minimal in a small account. I'd spend all the time I need in that safe environment where the stakes are low. Once I've proven consistency, the confidence follows. That's when it's time to scale up to a larger account. Now, some of you may be thinking, Ross, I'm intrigued about this whole concept of day trading, and you're so good at it. Why can't I just skip all the concepts and learning and simply follow you on each of your trades? What you're proposing is known as mirror trading. My strong recommendation is that you do not attempt to mirror trade me or anyone else for several reasons. First, I've been at this profession for a while, and my risk tolerance may not be the same as yours. I'll make judgments about what I should do that may differ significantly from what would be prudent for you to do. In some situations, I may decide on the spot that I can take the risk of losing $50,000 with a potential to make $100,000, which would be no big deal for me, but could wipe you out. Second, what you don't realize is you cannot trade fast enough to be exactly like me. It's not because I'm a keyboard wizard that can hit the keys faster than anyone else on the planet. It's because the financial markets these days are measured literally in millionths of a second, microseconds. A blink of the eye can be the difference of the price you get filled at. So even if I wanted to, I could not follow even other traders in real time and hope to get the exact same prices. You have to remember, we're competing against machines that can execute orders 1,000 times faster than we can. And third, what do you learn by just blindly following somebody else? If you are suited to this profession, and only a small percentage of people are suited for it, you must become self-sufficient at finding and executing your trades. That creates true independence. That's when you'll have learned how to catch your own fish. And it's so much better in the long run than just being fed trade alerts or blindly following me or anyone else. A challenge for some of you is that you may be thinking, I really like the idea of day trading, but the reality is I currently have a job that prevents me from trading in the morning when the market's open. Is there still a way for me to trade successfully? This is a tough question. To be honest, I don't know many traders who only trade in the afternoons and do really well in this business. Maybe they exist, but I'm drawing a blank. In terms of volume, the vast majority of trades occur during the first few hours of trading, from about 7:30 a.m. to 11:30 a.m. Eastern Time. Now, trading happens at other hours, but the morning window is when the most action happens. The reason is because this is when traders are reacting to the news that came out overnight and during the pre-market trading session. I know a lot of traders who have side hustles, who will trade in the morning and then do their other businesses the rest of the day. If you simply cannot be available to trade in the morning, you're going to be at a disadvantage. I'm not saying it's impossible, but I think it will be more difficult. And this is not to say that you can't practice in the afternoons, the evenings, or even on the weekends on replayed market data. But when it comes to trading the markets in real time, I really think you'll want to try to make yourself available for the morning trading sessions. For those of you who are really risk averse, you may be asking, can day trading ever be made really safe? Unfortunately, it can't. Now, although I can't predict the future of artificial intelligence and other technologies, from where I sit, day trading is always going to involve risk. At a fundamental level, you are trying to predict what a bunch of strangers and algorithms are going to do in the next few minutes or hours. You can apply a great deal of experience and risk mitigation techniques to lessen your risk, but it'll never go away entirely. Some of you may be listening and you're thinking, I like what I've heard about day trading, but I'm skeptical about my chances. I'm not a finance bro. I'm not some Red Bull drinking alpha male. In fact, I'm a woman. Well, this is shaping up to be a great question, and I want to answer it completely in the next chapter, so hold on to that thought. Chapter 4, the market does not care. Okay, we're back. At the end of the last chapter, you were asking a great question. You were saying, Ross, I like what I've heard about day trading, but I'm really skeptical about my chances. I'm not a finance bro. I'm not a Red Bull drinking alpha male. In fact, I'm a woman. And on top of that, I've never thought of myself as being good at math. Oh, and by the way, English is my second language. So give it to me straight. Do I even have a chance? The amazing thing about the day trading business is that it's agnostic. It does not care about your race, ethnicity, age, or your political persuasion. It only cares about your actions when you buy, when you sell, and for how much. You will be judged on your performance, period. It is a simple fact that most day traders are men. Fortunately, you can trade from your computer as much as you want and never set foot in some boiler room of the sort that was featured in the movie Wolf of Wall Street. In fact, other traders you speak with online don't have to know your gender, race, age, unless you tell them. Now I'll say, there are people in this business who shouldn't be in it. Look, there are people in this business who shouldn't be in it. In fact, a lot of them. They might see a tweet from some guy claiming to have made a ton of money on the next GameStop and how you're going to regret it if you don't get in now. The next thing you know, they're caught up thinking about how much they could make if they carelessly invest their life savings into this stock. This is what I would define as gambling. And unfortunately, it's more common than you might think. I'll be happy if this book persuades some of these impressionable people to not get into this business, because I've opened their eyes to how hard day trading successfully really is. But one of the main reasons I wrote this book is to connect with people who think day trading cannot work for them, but who are wrong. You're curious, or you wouldn't have bothered to pick up this book about day trading in the first place. But you're 5% curious and 95% sure that day trading won't work for you. In this short chapter, I want to talk to you if what I just said resonates with where you're at. First, I want to acknowledge that there is no level playing field for all investors at all times. It's true that the giant banks and the trading firms have a huge advantage over us little retail traders. We're the small fish. Those guys have vast amounts of money to spend. They hire armies of PhDs in mathematics, physics, computer science, and they spend a bundle on the data centers so they can trade not as fast as humanly possible, but as fast as the fastest computers can possibly trade. So let's stipulate all of that. Even so, day trading is an amazingly fair platform for the rest of us. Consider the following. There is no entrance exam to start trading. Contrast that with so many professions where membership fees and exams are a way to control how many people can be, quote, certified. Of course, people should still take day trading seriously and study it. A lack of exam doesn't mean there isn't a lack of information to know before you get started, but it does lower the barrier to entry. Next, the stock market does not care about the color of your skin, your gender, or your ethnicity. It doesn't care if you graduate from Harvard or never went to high school. The market doesn't care how famous or rich your parents might be. If you're going to succeed as a trader, it'll be on your own merits. The market also doesn't care whether you're using a $10,000 water-cooled computer versus a cheap laptop. Though it's true, having a couple of extra monitors will make your life easier, and if a computer crashes in the middle of a trade, it could create unnecessary risk. In Chapter 5, I'll describe the minimum setup you need to trade efficiently, but it's not expensive gear. The market is not a casino where the house always wins. While casinos will give you free drinks or show tickets if you blow a lot of money, they'll also throw you out of the casino if you're too successful. In the market, when you have an edge, you can use it to continue winning. Now, the market doesn't care if you, quote, deserve to do well, because you've always been a kind person who's led a virtuous life of helping others. You will place your trades and you'll experience the consequence. The market is not the least bit impressed that you absolutely kicked butt yesterday. You may have made more in one day than most people make an entire year, but today's a new day and yesterday no longer counts. The market, sadly, doesn't care how hard you're trying or how long you've been studying. Your buy and sell orders either produce profit or they don't, and you cannot reason with the market. You can't appeal a decision. You can't undo a trade. You decided to buy and sell, and your decision was final. These positive and negative consequences of a non-caring market may put many people off. However, I've found that things attract to the extent that they also repel. For people who have been put down or disadvantaged in some way in their lives, the day trading market provides a place where you can be judged purely on your actions, if you're willing to put in the hard work and learn the craft. For some people, that can be a relief, even a sanctuary. When I applied, unsuccessfully, to be an intern at a hedge fund in New York City, I was not on level playing field. I had no family connections. I had no prestigious college degree. I had no prior hedge fund experience. I had the interest and I was a hard worker, but for them that didn't matter. But when I chose the path of day trading, I was able to prove success on my own merits. Chapter 5, The Gear You'll Need. In Chapter 3, I referred to some hard costs of admission to the day trading community. Before we get into much more detail about the concepts and principles of day trading, we should make sure that you can cover these costs. You'll need a computer. Many people are surprised that I do all my trading on a laptop. They think I have some water-cooled beast of a custom gaming desktop rig. If it makes you feel better, go ahead and get that kind of gear. But I feel like being able to travel with the same laptop that I use at home is empowering. I got my first laptop in 1999 and I haven't looked back. Laptops for life. And you don't need one of the highest end $5,000 laptops either. A good laptop for trading will have a decent graphics card so you can run 2 or maybe 3 external monitors. I like Lenovo Legions and I like Falcon laptops, although I'm sure other manufacturers make plenty of very powerful laptops that would be perfectly adequate for trading. Now, it's easier if you run Windows, but it's not mandatory. And a lot of brokers still only offer Windows software. However, that's changing. If you open accounts with a lot of the bigger brokers like E-Trade, Fidelity, or Charles Schwab, you can use a Mac just fine. It's the smaller brokers that are still playing catch up and trying to roll out software that works well on a Mac. You will certainly do well to have a couple of external monitors. Confession time. At one point, I had 10 external monitors running simultaneously, powered by 3 computers. I thought that would allow me to really see everything that was going on in the markets. Over time, I found that was not the case because I reached the point of cognitive overload. You will probably find after 4 or 5 monitors diminishing returns. I need to have an uncluttered brain when I'm making trading decisions. Therefore, my minimum arrangement is to have my laptop screen and 2 external monitors. When I'm traveling, I use portable USB monitors that fit in my carry-on suitcase. They're not fancy 4K resolution, but simple 1080p. They hook up to my laptop via the USB connector, and I have little clips that attach the monitors to each side of my computer screen. On the left monitor, I have my scanners, which show me which stocks are really active at the moment, and I have a chart of the one stock that I'm focused on. On my center laptop monitor, I have my brokerage window, along with the Warrior Trading chat room, and on the right monitor, I have 2 more stocks that I'm watching. That gives me a total of 2 stocks I can watch and 1 stock I'm trading. These 3 stocks will typically be the top 3 leading percentage gainers in the market on that particular day. Now, when I'm at home, I don't use the USB monitors that clip into my laptop, but I have 24-inch Asus HDMI monitors that sit on a multi-monitor stand. My home trading station consists of 4 monitors, the laptop screen, and 3 24-inch external monitors. Now, perhaps it's stating the obvious, but I don't know any full-time professional traders who do all their trading from a mobile app on their phone. If you truly want to be a trader, it's wise to set yourself up with the similar equipment that other traders are using. So in addition to a computer and external monitors, you will need to open a brokerage account. This is where you will execute trades. Now, there are many different brokers that I like, but I don't want to name them in this book because the list changes from time to time. If you want to know which firms I think are acceptable at any given time, you can come over to warriortrading.com and search for our stockbroker guide. But of course, before trading with real money, you should always start in a simulator. There's really no point in opening a brokerage account and funding it with real money until you've first proven profitability in a simulator. Now, it's true that certain brokers will offer simulators to their clients, but currently most do not. When it comes to a simulator, these are the following requirements. The first is that it has real-time data. You want the simulator to protect you from losing money, but it also must not be similar to the stock market. It needs to reflect the actual stock market. Number 2, you need level 2 data. Level 2 data allows you to see the depth of the market. This is very important when you're learning to trade. We'll discuss this more later on. Number 3, the simulator needs hotkeys. Though I sometimes trade with a mouse, I can trade much faster with hotkeys. These can be programmed to do various functions with the click of a button. Number 4, trading history. It's crucial that you're able to export your trading history so you can analyze your previous trades. As we'll discuss in Chapter 11, this is one of the best ways to improve over time. Guardrail number 2. I should have used a simulator and proven that I could be a profitable trader there before ever risking a dime of real money. I also get the occasional objection. I don't use simulators because it's too easy to trade with fake money. I want to learn the business by having real money on the line. I think that's reckless for almost all people. If you have a trust fund or a business that's doing well, maybe you're fine with losing $20,000 or $30,000. But for the rest of us, the shortest and least painful way to learn the profession is to get good at simulated trading. Only then can you transition to real money trading. Not only will the simulator save you from losses while you're learning the basics, it will also boost your confidence once you can produce green days consistently. An even worse objection is when someone says, Ross, I can't afford to spend time trading in a simulator. I need to make money right away. So let me be the first to tell you that this mindset is setting yourself up for failure. Traders who come into the market needing to make money quickly will typically speed through the process, put undue pressure on themselves, and begin a rapid downward spiral. If you need to make money quickly, there are a million better ways to do it. With trading, you have to focus on the process, not the profits. The next thing you'll need is software to show you what to focus on. I'm a momentum trader, meaning I'm not interested in what stock might be poised to move up or might be undervalued. I focus on stocks that are moving right now. By using stock scanners, I'm working smarter, not harder. I don't need to research every undervalued company, read hundreds of pages of financial statements, or evaluate opinions of various analysts. You need software that shows you which stocks are making the biggest moves, which ones have the most trading volume, the highest relative volume, a valid news catalyst, and of course, the right float. I have my custom scanners that I make available to our community at Warrior Trading, but you could also get software from other providers. No matter where you get them from, you need to have scanners. And don't forget, you'll also need a reliable internet connection and a second way to connect. We've all suffered bad internet connections. I can tell you from personal experience, the fastest way to shoot your blood pressure through the roof is to have a connection that goes down in the middle of a trade. In Chapter 3, I describe just this sort of internet outage. If you are in a, quote, short position, you can lose a great deal of money, a career-ending amount of money, if you cannot act quickly enough to cover your position. Regard it as cheap insurance to spend a few dollars each month on a separate internet hookup that you can switch to at a moment's notice. Now, if you want to get fancy, you can even connect multiple internet service providers into a load balancing router so you can have a fail-safe without ever having any loss in connectivity. Now, you also need a support system. Otto von Bismarck, the German statesman, said, "Fools say experience is the best teacher. I prefer to learn from the other people's experience." I don't care how fast of a learner you are. You will not live long enough or have enough money to make all of the mistakes yourself that you can make in this business. If you are lucky enough to be brilliant and hardworking and patient, you will still find that day trading is hard. The only things that carry over from yesterday and your trading past are the knowledge and the skills you decide to apply. A trading community helps you apply what you know and stay disciplined. Warrior Trading has a great community with excellent resources, but no one has a monopoly on such things. If you find some other group that seems to offer the tools, knowledge, information, and support that best fits your personality and needs, by all means, go for it. Just be sure to find something that meets a set of minimum criteria. What are those criteria? The first is that it's a place where you can get well-informed answers to your specific questions about trading. And X or Twitter and Reddit don't qualify. It's too easy for people to dip in and out, brag, trash talk, and vanish. So you want to find a group led by people who can prove they're successful at day trading and not simply people who want to brag with no proof. Second, find a place where their software, tools, and strategies align with your risk tolerance, your personality, and your current knowledge. If you're learning momentum trading that's focused on small cap stocks, the tools and community should be largely following the same trading profile as yours. Third, look for a group where you find a compatible chemistry so that you can derive support and inspiration from them. In case you hadn't gathered, something about me by now is that I'm not a big extrovert. Even so, I believe it's critical to take part in an online community of like-minded people. It's been said that you become like the people you surround yourself with. There are communities with personalities that thrive on bullying, negativity, and hostility. These communities are not conducive to learning. It's not hard to tell which ones have a foundation in positivity versus negativity. Ultimately, you are alone when you hit the button to buy or sell shares. You sink or swim on the instant judgments you make, but you can reduce your risk of making irrational decisions by listening to the regular thoughts and perspectives of other traders whose opinions you've come to respect. And I can tell you that your intuition will get better as you gain more experience. But of course, this process takes time. At first, you won't be sure about who thinks and acts similarly to the way you do. But if you get in the right group, you'll come to value the support and sense of shared mission. This chapter has been about the minimum gear you'll need in order to begin your trading journey. The next chapter will cover some of the knowledge you must have before you ever think about placing your first trade. Chapter 6, Stock Market Basics. Of course, I can't teach you everything I know about day trading and somehow cram it into one volume. But what I can do in this book is teach you everything you need to know in order to be well informed about the day trading road you're considering. In the last chapters, I've already thrown around several terms like small cap and swing trading. You and I start a business. Let's say for this chapter that I'm back in Vermont and you and I know each other from high school and we've reconnected at a reunion. It turns out we've both enjoyed Ben & Jerry's ice cream for years, and both of us had sent in ideas for flavors, but those ideas fell on deaf ears. After a while, we decided to open our own small ice cream shop, and then another, and now we've got 8 more. People adore our flavors. We've got the tiger by the tail here. Now we definitely want to grow this thing as large as we can make it, but merely investing our profits is inhibiting our plans. It's nice and it's safe, but we see an opportunity that won't last forever. So we need to grow much faster than we can fund with our own money. Equity versus debt. We have some options. We could do debt financing in the form of a bank loan, and that's okay, but we realize that the interest payments would kill our profit margin. Furthermore, the debt repayment comes right off the top of our revenues, meaning that we must repay the bank before we're paying any of our own expenses. We decide we need to preserve our profit margin, but we're willing to share the wealth in another way. We want to do an equity offering. The bad news with giving someone else equity is we're sharing the ownership of the company. At least with debt, the bank gets a slice of the money, but nothing else. If we do well, we don't have to share the extra profit with the bank. But if we're having a hard time, the bank doesn't care. It wants the money. Not only would we be personally guaranteeing the loan, the bank would likely require us to put up collateral. So if we don't pay, they can grab whatever that is and sell it. By sharing equity, we in effect are taking on money partners who will share in all the profits we make. On the other hand, if we have a big expansion year and there are few profits, they will take nothing off the top, but will get smaller checks, just like us founders. A brief note about debt offerings. If we're a big company, we could decide to issue bonds, which is another form of debt. There's a whole spectrum of types of bonds. Large companies, even the US government, issue bonds. Some are senior to other types of debt, meaning they must be repaid before others. There are even bonds known as debentures, which are not backed by any collateral. They will only be repaid if the company has funds. Why would anyone buy such bonds? Because they come with a great interest rate. The more risk investors are willing to take about getting repaid, the higher the interest rate they can expect. Types of equity. Now that we decided to do an equity offering, we have a choice, private or public. If you follow the financial news, you'll hear about private equity firms all the time. They can write big checks quickly and then suddenly have a big say in how the company operates. It's similar to venture capital or the Shark Tank show, where you maybe get $1.5 million in a funding round in exchange for 10% ownership in the company. In that scenario, your company is valued at $15 million because a 10% slice is valued at $1.5 million. Private equity is called private because there are no shares available on stock exchanges. It was a private transaction. But instead, we decide to go public. That means we want to sell shares in our company and have them listed on an exchange. The first time a company issues public stock is known as an IPO or an initial public offering. The world's most famous stock exchange is the New York Stock Exchange, or NYSE. At first, it was pretty much the only game in town, but that's changed. Now there are 13 stock exchanges in the US alone. The 16 largest stock exchanges in the world each have a capitalization of more than $1 trillion. A word about public companies. When you go public, you'll be forever scrutinized by stock analysts. Some of them are incredibly experienced and knowledgeable professionals who are true experts in certain industries, but others are fresh out of business school, and the last business they ran was a lemonade stand. Either way, they'll issue analysis and earning estimates about companies each quarter. The true experts, and others, issue public opinions about companies and its prospects for growth. Often, a battle ensues between the analysts and the companies about those future prospects. It's enough to cause some companies to avoid going public altogether, or actually to reverse a public offering and go private through a share buyback or a buyout. That's exactly what Twitter, now X, did. Types of stock. Each exchange has its own rules about the type of companies that can issue stock. Let's say we decide to list our stock on the NASDAQ, which is one of the largest exchanges in the US. Then we had another decision to make, the type of stock to issue. The standard kind is known as common stock, but there are other types like preferred stock, which can claim more rights in terms of dividends and other assets of the company. There's also non-voting stock and many other types. Dividends. There used to be something called widow and orphan stocks because they paid generous dividends, which are partial payouts of the annual profits of the company. Those were also known as blue chip stocks. The idea was that a widow or an orphan could survive on the income from the dividends that these stocks paid. Some stocks pay relatively significant dividends and others pay none. Why wouldn't everyone want a stock that pays a bunch of dividends? Because that money goes out the door. Many companies realized they could expand and invest in better equipment and a larger staff with those dollars, instead of writing checks to shareholders. That money may help the stockholders briefly, but it does nothing to help the business. So we decide to issue common stock on a plan of paying no dividends. This is very typical of a new IPO. We need this money from the IPO to build this company into a powerhouse as soon as possible. And the shareholders will thank us later as the value of the company and the price of their shares increases. Details. Because you and I are experts in ice cream and not finance, we hire an underwriter. The company knows all about stock offerings and also when is the best time to go public. If the US economy is currently weak, then our underwriter may advise us to hold off. After all, we want to issue stock at the highest price per share that we can get. That price is partially driven by the assets we've built up in the company and partially by the investing climate on the day that we issue shares. Pity the company that decides to offer shares when something like COVID splashes into the news. No matter how good the underlying company might be, investors will be skittish and they won't want to pay much for anything. We huddled with our underwriter and chose a date for our IPO. Part of the concept of underwriting is the due diligence that the underwriter performs. That's an analysis of our company and its management, prospects, and risks, among other things. The underwriter also helps submitting a whole lot of documents to the Securities and Exchange Commission, or the SEC. They have detailed requirements about the many disclosures companies must make when issuing stock. The main document relating to our stock offering is called the prospectus. It contains an overview of the company, its management, nature of operations, known risk factors, and prior financial history. The prospectus is submitted to the SEC, which does not approve such filings, but acknowledges receipt of them. Among other things, the SEC requires that we issue annual reports known as 10-K filings. Because our stock is available in the public markets, these filings become public information when we file them and is available at the SEC's website. Quarterly reports are also called 10-Q filings. And if we have important news to report about our company between quarterly reports, we must issue an 8-K filing. There are many other types of filings related to ownership, voting, and so on. The big day. When the day actually arrives for the stock to go public, an official price per share will be set. Then the actual sale will begin for those shares. When Apple Computer stock was listed for the first time, there was worldwide interest in buying those shares. They were offered at $22 a share on December 12, 1980. All of those shares were snapped up in minutes as trading commenced under the stock symbol AAPL. People who bought them at $22 a share might have thought that a quick profit of $5 per share was great and sold their shares at $27. Perhaps a few investors might still own Apple shares they bought in 1980, over 40 years ago. But most shares have traded hands many times, even on the first day. By the end of its first day, Apple shares were trading at $29 a share, almost 32% higher. It's important to understand what happened in this example of Apple. The company was paid $22 for each share investors bought. That's all the company got from the IPO. Though, of course, it also got a great deal of publicity, which doesn't hurt a company that sells retail products. Those original buyers of Apple were then able to sell their stock to other investors at a higher price. The result was that the marketplace had valued Apple stock by the end of that day at $29 a share. It may mean the underwriters priced the IPO a little low. It may mean the $22 share price the underwriters chose was a little low. Over the years, the original shares kept being valued more and more by the investing community. In fact, Apple has had a series of stock splits where they would issue more shares for each share you owned, albeit at a lower price. For example, 7 years later, Apple offered a 2-for-1 stock split. So each share was worth half as much, but you got 2 shares for each share you owned. Companies do that so their shares don't get insanely expensive on a per-share basis. Warren Buffett, however, does not believe in stock splits, so 1 share of Berkshire Hathaway now costs more than $400,000. If you had bought 10,000 shares of Apple at the IPO and held on to those shares, they would be worth more than $14 million today. Market capitalization. You've heard me talk about small cap stocks. If you take the current price of a company's stock and multiply by the number of shares the company has issued, you get the market capitalization. If that number is more than 10 billion, it's called a large cap stock. If it's from 2 billion to 10 billion, it's called a mid cap stock. And if it's between 300 million and less than 2 billion, it's called a small cap stock. The small fry below 300 million are known as micro cap stocks, and tiny companies below 50 million are known as nano caps. Although it's possible to day trade any stock from large cap down to nano cap, as you learned in Chapter 2, I prefer to trade stocks with a limited number of shares available. This reduces the supply in the supply-demand equation. That means I focus more on float than on market capitalization. Remember that float is the number of shares available to trade, and it comprises of the shares a company issued through IPOs and secondary offerings. When you focus on float, you'll generally find yourself trading stocks with market capitalizations of less than 1 billion. If I focus on trading stocks priced under $20 a share with a float of less than 50 million shares, that means the largest market cap I would typically trade, 20 times 50, is $1 billion. There are certainly exceptions to this. I will eagerly trade large cap stocks, including Facebook, Alibaba, Uber, Airbnb, and Snapchat on the day of their initial public offering. I might also trade them on days when they're having a once-in-a-decade type of news event that has sparked massive volatility. But generally speaking, I find more consistency in stocks with smaller market caps. Back to our stock. Let's say we completed our IPO at $10 a share and all our shares were purchased. Now that doesn't always happen, but we had a good underwriter. And then trading commenced on the open market. When that happens, you see 2 prices, a bid price and an ask price. Sometimes the ask price is also called the offer price. The bid price is the highest price a buyer on a particular exchange is willing to pay. It's like bidding on something you want to buy on eBay. The ask price is the lowest amount that one or more sellers are willing to accept for their shares. It's super important to keep in mind one thing. These shares are being auctioned. In the 1700s, when the New York Stock Exchange started, you had a bunch of men in top hats down on Wall Street in New York City auctioning off shares of stock the way they might auction a bale of hay. If people really need hay, it goes to the highest bidder. If there's too much hay available, the price drops because the buyers can take their time and negotiate lower prices. It feels like we live on another planet these days with all our technology, but the auction principle is the same in the stock markets. In our new company, after the shares initially were purchased at 10, the bid price moved up to, let's say, $11.57 because there were more buyers than sellers. At that time, the ask price was a bit higher at $11.77. Understanding spreads. The 20-cent difference between $11.57 and $11.77 is known as the spread. Some stocks will trade with a 1-cent spread, and others will regularly trade with a 25, 50-cent spread or more. Minimum spreads are regulated by the exchange. The rule states that a stock priced over $1 must be quoted in increments of no less than 1 cent. That means the smallest spread you would see on a stock over $1 would look like $10.05 by $10.06. However, for stocks under $1, exchanges allow quotes down to the 1/100th of a penny. Therefore, you could see a stock like this, 0.0001 by 0.0002. That would be the lowest price stock on the entire market, and that right there is the bottom of the barrel. What's interesting about this is that for a stock to move from 90 cents to $1, it's only 10 cents. However, since sub $1 stocks can be priced by the 1/100th of a penny, in theory, it could take 1,000 increments if the stock began trading at 90 cents, 0.9000, and slowly moved up to 0.9999 before breaking $1. Then it could go from $1 to $1.10 in only 10 increments. As you know, I rarely trade stocks under $1, and the price quote is one reason. The 1/100th of a penny spread is too tight. So what exactly does the spread tell us? A wide spread typically reflects low participation of buyers and sellers. This can occur on both large cap stocks and small caps. If a stock has a wide spread with no volume, there will be no volatility. However, if a stock has a wide spread and has breaking news, the wide spread combined with higher relative volume can actually fuel volatility. The important thing to highlight is the difference between high relative volume and high average volume. Many large cap stocks have higher levels of daily volume than small caps, simply because of large investment funds, mutual funds, and individual investors buying and selling shares of those familiar companies. This increase in average daily volume can create tighter or more narrow spreads. To profit from the frequent buyers and sellers, large institutional investors become registered to serve as market makers. This is a business of arbitrage. Market makers serve as middlemen, much like auctioneers in the 1700s on Wall Street. They buy from someone who is selling and they resell those same shares to somebody who is buying. They profit from the spread of the stock, and thus they have an incentive to keep the spreads larger. Competition among market makers combined with high participation from traders will create tighter spreads. The competitive market making that creates tight spreads will be far more present on stocks that have high average daily volume with low average daily volatility, because market makers carry the risk that while they're holding the stock, bad news could come out that creates volatility. Certainly, some stocks are more prone to this happening than others, such as small caps. Thus, the best opportunity for market makers to generate consistent daily profits with minimal risk is to focus on stocks with higher average volume, lower volatility, and those are large cap stocks. Today, market making has become automated through high-frequency trading algorithms. These algorithms can adapt to changes in the market instantaneously. They provide tremendous liquidity by placing orders both on the bid and on the ask when stocks have lower volatility. But when stocks experience heightened volatility, the algorithms turn off. The market makers close up shop to manage their risk. This is when day traders step in to capitalize on the volatility without competing against institutional traders. When I'm trading, I don't love to see a stock with a 1-cent spread, nor do I want to see a stock with a 50-cent spread. There is a sweet spot. More than anything else, what I look for is fast rate of change. I want to see a stock moving up quickly. Once a stock is moving up 10% on the day, and certainly if the stock is moving up 5 to 10% in less than 10 to 15 minutes, we will see algorithms turn off as volatility spikes. Spreads may get bigger, perhaps 10 to 15% on a stock under $20, but that is perfectly okay with me. Once the stock comes back into a period of consolidation, the market will seem to fill back in with orders as market makers resume their positions on the bid and the offer. Volatility and liquidity. You will hear me say more than once in this book that I'm a hunter of volatility. I hunt for stocks where the price is changing quite a lot at the moment. I also look for stocks where the rate of change is happening with many shares changing hands relative to the normal activity of that stock. That's what creates the high relative volume, not to be confused with high total volume. If a stock has an average daily volume of only 100 shares a day, and then today trades with 10,000 shares of volume, although it does have a relative volume ratio of 100, there may not be enough liquidity to buy and sell shares of the stock. Liquidity comes in the form of market makers posting orders to buy and sell shares, as well as individual investors placing orders. If a stock has few orders, it will have a wide spread. And although it could move quickly with news, big moves on low liquidity stocks can be especially difficult to trade. Just as with spreads, there is a sweet spot when it comes to relative volume, total volume, and liquidity. And no two trades or stocks are exactly the same. Now, as the owners of our publicly traded ice cream company, our goal is to expand the company, increase public awareness of our brand, and as a result, see the value of the company grow. This should be reflected in the share price. Because we don't pay dividends, but reinvest our profits to fuel future growth, the only reason a shareholder will be comfortable holding shares is if the share price is steady or moving up. That means we must meet or exceed our earnings expectations to continue to paint a picture of how even more valuable this company will be in the future. Now, as owners of the company, we couldn't care less about day traders. Through our quarterly and annual filings, we tell shareholders and prospective investors how we are doing. We also have the chance to issue press releases to announce exciting news. Publicly traded companies have an investor relations department that not only does the regulatory filings, but also handles publicity and news releases. But day traders are often among the first people to pick up on news released by a company. I always view these press releases with a certain skepticism. Companies naturally will try to paint themselves in the most flattering way. When breaking news hits the news feeds, high-frequency trading algorithms are typically the first to execute trades. They are programmed to read headlines and execute trades based on certain keywords. Keywords like buyout, merger, contract with Apple can all trigger what is called an algo spike. This is when the algorithms initiate buy orders on a low-volume stock. This sudden surge of volume can trigger market makers to pull back their orders. Within a minute, the price of a stock can skyrocket. This is great news for day traders, and it's great news for the company too. Ultimately, the substance of the news headline does matter. Over the course of hours, and certainly over the course of days and weeks, the market will begin to align with the correct value of the company. However, in the moments when the news is breaking, and during periods of heightened volatility, stocks can become very disconnected from their true market value. Let's say, as an example, we put out news that our ice cream company brought a former Walmart executive onto the board of directors to get our brand on their shelves. Could the stock price surge from $10 a share to $20 a share in a single day? If the float of our stock is less than 50 million shares, it's not unthinkable. This is how a company can double in value virtually overnight. Over the following weeks, it's possible that analysts, market commentators, and traders will begin to think the company could be huge. In that case, the price could continue to rise all the way to $50 a share. Now, let's say for a variety of reasons, an agreement doesn't materialize and our ice cream never makes its way onto Walmart shelves. It means for a period that our share price was very disconnected from the true value of the company. But remember, it's not the current value of a company that creates its stock market price. Traders and market participants buy up a stock based on the perceived future value of the company. As day traders, our job is to hunt for such volatility because that is where we'll find opportunity. Margin. When you first open a brokerage account, you'll notice an option to apply for margin or to open a cash account. A margin account allows you to do a couple of things you can't do in a cash account. The first is that it allows you to leverage your account to borrow money on margin, which is credit, from your broker in order to buy more stock. Brokers in the United States offer 4 times intraday leverage and 2 times overnight leverage. That means with a $25,000 account, you could day trade with up to $100,000. That is risky. It means if you bought 10,000 shares of a $10 stock worth $100,000 and it went up 10% in one day, you'd have a profit of $10,000. That's a 40% return on your $25,000 account, unless it lost 10%, in which case it's a 40% loss. Buying on margin is an asymmetrical results magnifier. You can multiply your profits, which is nice. Then again, margin has the potential to wipe you out. The risk of blowing up an account is not worth the benefit of making more on a winner. The fact that you, as a beginner, will be offered margin by your broker should not be interpreted as a recommendation to trade on margin. Your first order of business is to manage risk. Guardrail number 3. In retrospect, I would not trade on margin until I've proven I can make money consistently using my own cash. And by consistently, I mean 6 to 12 months of profitability. I also need to have experienced drawdowns and proven I can recover from them. More on drawdowns later. The long and short of it, money begets creativity. Ever since stock exchanges began, there have been people with ideas about how to make trading more sophisticated, more complex, or more confusing, depending on how you look at it. Take the concept of short selling, for example. When someone buys stock in our new ice cream company, that person goes long or has taken a position, as we say. You buy a stock at what you hope is a lower price, own it, and then sell it at some point in the future for hopefully a higher price. But there's an opposite way to do it. You can borrow stock from someone else, sell the stock, and then buy it back later. Huh? What's that about? I know it might be confusing. You don't own the stock, someone else does. You borrow shares from them, you pay a fee for those shares, and then you sell those shares at what you think is a high price, and you plan to buy the shares back at a lower price and return those shares to the original owner. Your profit or loss is the difference between the price you sold the shares at and the price you buy them back at, not counting fees. Short selling is a big business. Not as big as being long, but still many people are short sellers. They're famous for being the stock market bears who think everything is going to hell, or they think everything is overvalued. This is also why some people will trash a stock in television interviews, on social medias, or in chat rooms, because they're literally invested in seeing the stock go down. The topic of short selling is involved, so I won't get into the details here except to say, guardrail number 4. I would have avoided shorting stocks with real money until I established a profitable track record of trading in a simulator for at least 3 to 6 months. You have a whole career ahead of you where you can make money and lose money in all sorts of interesting ways in the market. The reason to stay away now is simply this. If you're in a long position and you bought shares at a cost of $5,000, the most you can lose is $5,000. If you sold short for $5,000, you could lose multiples of that $5,000, and it can happen in minutes. I've seen a stock go from $20 a share to over $2,500 a share in less than a week. This could turn a 400 share short position, valued at a mere $8,000, into a loss of over $1 million. Of course, inversely, this stock could have provided tremendous opportunity for traders who bought while it was increasing in price and who followed their strategy and knew when to take profit off the table before overstaying their welcome. When you're first learning to juggle, I suggest you start with soft beanbags, not running chainsaws. Now that we've covered some foundational definitions, let's move on to the next layer of what you need to know in this business. Chapter 7, the battle that will happen between your ears. I don't want to be overly dramatic when I say that a battle will soon happen between your ears if you choose to day trade. On the one hand, you're not going into a real combat situation, but what I see all too often on social media is a casual approach to day trading, as if it's a hobby like gardening. I was reading about a guy who bragged that he traded on his phone at stoplights while driving for Uber. He might be trading, he might even be day trading, where he closes out all his positions by the end of the day. But he is by no means what I would call a true or professional career trader. To be a true day trader, you need to work hard to put several things in place. Number 1, you must understand the terminology and how the markets work. This book is a solid introduction to that knowledge, but there's always more to learn. Secondly, you'll need certain equipment and assets to get started. For example, you'll need a brokerage account to trade in, appropriate equipment, and at least a minimum funding of your account. We've covered that already. And third, you must understand how very risky day trading is. Your chances of succeeding long term are severely stacked against you, unless you take every opportunity to reduce those risks. We'll discuss how in a moment. Another way to say it is you need to stand on someone else's shoulders and internalize a whole lot of principles. What I want to emphasize here is that it's not only vital that you have a support system when you trade, you must also study hard to learn and use a set of principles that are worth their weight in gold. If you follow these principles that are hard won from people who came before you, it's possible that day trading could be for you. If you don't follow them, it's almost certain you'll be ground up and unceremoniously spit out in this business. The first set of principles relate to your noggin, what's in there that should not be, and what you need to install into it. Taking out the trash. You need to carefully curate what you put in your head. You don't need to look far to see mountains of junk in the form of social media trash talking. It's bad enough to hear the normal stuff on social media about politics, celebrities, and so forth. That kind of endless chatter is just a big, harmless waste of time. But when you get your information about day trading from social media, now you're playing with fire. Day trading is difficult enough on its own. Every moment, you have to be separating the signal from the noise. What's happening, what it means, when you detect a pattern, and what to ignore. Do not add the additional noise of social media to the significant cognitive load you're already under. Be careful of whom you tell that you're day trading. Ignoring this bit of advice can ruin your trading career before it even gets off the ground. In Chapter 3, I discuss some of the myths surrounding day trading. Most people you know will believe some of those myths and maybe more. You might hear, "You're doing what? Don't you know it's pure gambling? Don't you know you'll lose your shirt?" Or, bless your heart, but you've never been good with numbers. What makes you think you'll be able to be a good trader? Or, if that was a sound way to make money, wouldn't Warren Buffett and Elon Musk be doing it? And perhaps, I know a guy who lost his house, his wife divorced him, and it was all based on his day trading losses. And don't you remember when cousin Ralph tried it and lost his butt? And he went to MIT. If it didn't work for Ralph, it is not going to work for you. When you're just starting out in day trading, even a well-meaning comment from a loved one can mess with your head. When you announce to the world that you're a day trader, you create expectations for yourself and for others to measure you by. You'll have plenty of time down the road to tell others what you do, if you stick with it. But for now, I suggest you tell as few people as possible. Keep your circle small, preferably consisting of people who can be supportive as you're learning. Focus more on the risk you need to manage instead of the return you'd like to have. You most likely already know that day trading can be profitable, or you wouldn't have picked up this book to read it in the first place. The type of investors who buy and hold for the long term will typically look for 5 to 10% annual returns. Contrast that with day traders who are looking for trades that have the potential to make 5 to 10% in a single day. That kind of return comes with a high corresponding risk, but there are some day traders who won't stop there. They'll trade those incredibly volatile stocks on margin with leverage. In Chapter 6, we discuss the risk of using margin and leverage. It has the power to amplify gains and losses by a power of 4. It's true that profits are potentially available for traders who work hard and learn the craft. The only little problem is that it takes great skill and dedication to realize that upside. Of course, it takes no skill to be the owner of all the downside. Your next tattoo. The whole purpose of this book is to paint a truthful picture of how day trading really works. I also want you to understand what it will really take for you to become a good trader. Then you can decide for yourself if it's a good fit for your situation. Books are long, and it can be hard to remember most of what's in them. Therefore, I want to hand you a big, shiny nugget. A day trader is a hunter of volatility and a manager of risk. Think about that getting tattooed somewhere. If you're sound asleep on a commuter train and someone shakes you awake and says, "Who are you?" your automatic answer should be, "I'm a hunter of volatility and a manager of risk." We'll talk much more about this in the next chapter, especially the volatility part. But let's first examine risk management. How you measure a trade before you take it. When professional day traders look at a possible trade, they describe it in a very particular way, not using adjectives like amazing or epic, though some may brag in that way later over a beer. But in the moment, they instead describe the trade in terms of expected profit potential and acceptable downside risk. Let's take a stock that's selling for $10 a share. I'm thinking about trading 100 shares. Based on my analysis of where the stock has been trading recently and where it is right now, I think my next trade has the potential to go up $1 a share. When I take that trade, I don't want to stay in if the stock suddenly drops 50 cents a share or more from my entry point. This plan could be expressed in 3 ways. On a per share basis, it's buying at $10 with a profit target of $11 and a maximum acceptable loss at $9.50. For the trade of 100 shares, I could say that I'm buying in with $1,000. My target for profit is $100, while my maximum acceptable loss is $50. If we want to look at ratios, then it's expressed as target profit divided by acceptable loss. That means $100 divided by 50 or 2 to 1. They're all the same trade, but expressed differently. You'll come across each of these ways of describing a trade, so it's good to be familiar with them. But Ross, how can you be so sure of the profit potential and the acceptable loss amount? You haven't made the trade yet. Where is your crystal ball? That's a fair question, and I'm still searching for my crystal ball, but until I find one, I need to use the next best thing. I must rely on day trading principles and knowledge in general, and the trading history of the stock in particular. I call this educated intuition. The upside measurement of $100 in this example should never be what I merely hope is going to happen, but is based on a defensible and rational expectation. However, the downside risk of $50 should indeed be a firm number, as you'll see in a moment. Now that we can describe trades, let's look at a typical situation. Imagine a trader who has just made 9 trades. In each trade, there was $100 of profit potential and $50 of acceptable risk. Therefore, each trade had the upside potential to double the downside risk for a 2 to 1 profit to loss ratio. Those first 9 successful trades produced $900 in total profit. Great work. Later we'll discuss why and how you should let your winners keep winning. But for now, let's just stick with this example. On the 10th trade, our trader found himself down $50 pretty quickly, but the day's gone so well. Instead of accepting the loss, the untrained trader purchased more shares at a lower price. After all, that's good investing, right? Buy low, sell high. He's now dropped his average cost. Because he bought some stock at $10 and added more at $9, he has an average cost of $9.50 per share. That's good, right? Well, things quickly moved, and not in the direction he wanted. Hope is not a strategy, and eventually the trader finally took a loss when he was down over $1,000. On paper, this trader has a 90% success rate today. 9 out of 10 trades were winners. That's great, but he's down $100 on the day. $900 of profit from the first 9 trades against a $1,000 loss from the 10th. He failed to manage his risk. How to become a world-class loser. Over my many years as a trader and also as a leader of a trading community, I have heard from literally thousands of traders and aspiring traders. Most have experienced a devastating loss at some point because of avoidable mistakes. We call these unforced errors. Some of them went downhill spectacularly quickly because they were trading on margin. Brokerage firms provide useful services, but one of them is not being your trading chaperone. The money to trade on margin is a few mouse clicks away, and the allure of quick profits can lead new and even seasoned traders to ignore what they know in favor of what they feel at the moment. The small number of traders who consistently profit from the market have one skill in common. They cap their losers. In fact, they are world-class losers. Who would want to be such a thing? You should, because in your career as a trader, you will do a lot of losing. On a really good day, you will win more than you lose, and you will end the day with a net profit. But I can assure you, with tens of thousands of trades under my belt, even on those good days, you will have at least a few losing trades. Becoming really good at handling loss can mean the difference between prospering in this business and washing out. Successful traders accept that each trade should have a predetermined level of risk. They articulate that risk level ahead of the trade, and they adhere to the rules they set for the trade. It's that simple, and it's a critical part of a well-defined trading strategy. Compare that to the untrained, shoot-from-the-hip trader. He wants to stay flexible so he can adjust his risk parameters mid-trade to accommodate a losing position. After all, he set his sell level at minus $50, but when the trade went down to minus 60, he thought, I'll just hold it for a few more minutes and see if it comes back up. Before he knows it, he's looking at an $80 to $100 loss or worse, and he's wondering how it happened. Ask me how I know this. I will be the first to admit that it's extremely difficult to maintain the level of discipline needed to sell when you hit your max loss on a trade. Nobody wants to lose, but the best traders know it's part of the business. If a salesperson freaked out every time he or she struck out and didn't make a sale, they wouldn't be in sales very long. The sales pro follows the system and knows the statistics. After a string of rejections, a sale statistically is right around the corner. It's also worth reminding yourself that losses shouldn't be considered mistakes. A mistake is when you break the rules of your strategy. A loss is simply when you take a trade based on your strategy that didn't work as expected. You stopped out at the correct price required to maintain a healthy profit-to-loss ratio on your trades for the day. In other words, you took the proper actions. Dedicated traders accept their losses without beating themselves up, and they move on to the next trade. And one thing that's very important is they never allow one trade to destroy their account or their career. This characteristic helps keep them in the business as long as possible. Lifelong valuable skill to learn: mindfulness. The skill to take losses and not allow them to cause you to lose focus is an act of mindfulness. In our popular culture, mindfulness is usually confused with meditation, but they're not the same. Mindfulness has nothing to do with sitting in a certain pose, with your eyes closed in a calm setting, holding your fingers in a certain way. You can be mindful while running flat out or while intently looking at a stock trading screen. Mindfulness is a way of stepping back mentally and observing what your own brain is doing at the moment. I highly recommend that you explore this technique. One way to do it is to get a book by Jon Kabat-Zinn called Wherever You Go, There You Are. Our human emotions often work against us when we're in the thick of a trade. The emotions of fear and greed are present in every trader, including me. The best traders can experience those emotions without acting on them. When you allow your emotions to overtake your rational thought process, you risk overtrading, exposing yourself to unnecessary risk and excessive losses, and succumbing to emotional impulses. At least in my experience, it takes years of emotional conditioning to be able to sit down even for 2 solid hours watching the live trading action while maintaining emotional composure the whole time. But when you can do this, you'll have reached a new level of mastery over your emotions. This composure during a stressful situation will carry over into the rest of your life. If you can be a day trader with big money on the line and keep your composure, well, the run-of-the-mill daily frustrations will also become easier for you to handle. We're not quite done exploring the forces at work in your head when you trade. We must confront a pair of 4-letter words that have a lot to do with whether you will sink or swim as a day trader. That is coming next in Chapter 8. Chapter 8: Risk and Fear in Trading. Some things cannot be separated. 2 sides of a coin is one example, and another is the experience of risk and fear in day trading. This isn't shaping up to be much of a rah-rah book about trading, is it? It would be more fun to talk about the huge profits instead of fear and risk, but that wouldn't be doing you a service. We're going to look at both of these concepts in the eye. We'll not be able to eliminate risk and fear, but we can take specific steps to reduce both of them. Profit-loss ratios in more detail. In the last chapter, I introduced you to the crucial concept of the profit-to-loss ratio. This is another example of what should be inseparable, but what is not to most inexperienced traders. You should never even consider taking a trade when you haven't already focused both on the upside potential and the number where you will sell if things go south. Maybe the path of least resistance is to trade with your gut instincts because things are moving fast and you don't want to set your loss numbers, but don't take that path. Now, I'm not dismissing intuition, but I'm saying that beginner traders need to follow best practices more than anyone. They don't have the experience and the bankroll to be wrong too many times. Taking away the safety net is no way to learn the trapeze. I have both my experience and the bankroll to go with my gut at times, but even so, I set my max loss number before I take a trade. And I can't tell you how many times it saved my butt. In the last chapter, we looked at the example of a stock where we would set our maximum acceptable loss and profit target. Let's put that trade into graphical terms. That will make it easier to understand another important calculation. Now, I'm going to use a stock price that I don't normally trade, but just so the math is very clear. Let's say we have a stock trading at $30 a share. Based on experience and the stock's current behavior, my profit target for the stock is $40 a share. In real life, I wouldn't have a max loss 33% away from the current trading price, but just for the sake of this example, let's stick with it. My maximum acceptable loss is $20 a share. Now you can see in this example, I'm risking $10 to make $10 per share. In Chapter 7, we looked at the example of a trader who had a success rate of 90% over 10 trades, but still lost money. He didn't establish and stick to his maximum acceptable loss in just one trade, and that killed his entire day. For some traders, especially traders who take positions to the short side, one mistake like that could ruin their entire career. Now remember, success rate is how often you are green or profitable. In the example of buying a stock at $30 a share with a max loss of 20 and a profit target of 40, we stand to gain the exact amount we're willing to risk. This is called a 1-to-1 profit to loss ratio, and it would require 50% accuracy in order to be break even. In other words, 50% of the time I take that trade, I would need to be profitable in order to break even. But Ross, what if all my losing trades lost by $9, but all my winning trades won by only $1? Couldn't I be red overall and still have a success rate of over 50%? Yes, you could. And in fact, if you ignore the maximum acceptable loss and ride those red trades down, you'll quickly kill your overall results. But I'm assuming, for the point that I'm about to make, that there's going to be a random distribution of results. Now let's say we make things a little more dire. Let's say we buy a stock at $30 a share with a max loss of $10 a share, and the profit target is still only $40 a share. This is called a negative or inverted profit loss ratio, where we are actually risking twice what we're willing to make. In this case, we would need to be right 66% of the time in order to break even. Conversely, if we buy a stock at $30, we set a max loss at $20 and a profit target of $50 a share, we would have a 2-to-1 profit to loss ratio, and we would only need to be right 33% of the time in order to break even. That's what I call setting the bar low. However, I will say that it's easier said than done to find trades where your profit potential is many multiples of whatever you're risking. These two numbers tell me a lot about a trader. Profit-loss ratios are often overlooked by novice traders who maybe don't appreciate the probabilities we just covered. But remember, at the end of the day, success or failure can be viewed simply by the metrics of your trades. Guardrail number 5. I generally look for trades with a minimum of a 2-to-1 profit-to-loss ratio. Traders are eternally optimistic, and I'm no exception. So if I think something has a 2-to-1 profit-to-loss potential, I'm likely to walk away a little short, but that's okay. I just have to factor that in and always aim a little high. The reality is, in trading, you can control your downside by setting a max loss. But the upside profit target, whether it's obtainable, can be an educated guess. Those guesses will typically get better with experience, and that's what I call educated intuition. So aim high with the 2-to-1 profit to loss ratio target, but make sure you can maintain at least a minimum profit to loss ratio of 1-to-1 when all is said and done. If you can maintain a profit-loss ratio of 1-to-1, you can be break-even while being right just 50% of the time. The first thing I tell traders to look at is their trading history. All traders should know their profit-loss ratios and their success rate. These two numbers will indicate whether a strategy is sustainable. If you can trade with a 1-to-1 or even a 2-to-1 profit-to-loss ratio, it becomes much easier to succeed. Of course, to get higher profit-to-loss ratios, you may need to be more selective about the trades you're willing to take. That may mean you trade less frequently as you wait patiently for great opportunities. It puts pressure on you because you may even have to sit for an hour or two or a whole trading session without seeing a single opportunity that meets your criteria. It takes experience and discipline to pull it off because it can feel like you're not doing a lot of anything. In Major League Baseball, the new kids who just want to make the team may want to swing at each pitch because they want so badly to prove their worth, but the veterans know their strengths and their weaknesses. They might know, for example, that their personal sweet spot is to wait for a fastball that's high and inside. They'll be patient, and they'll even be willing to look like they're not doing anything for the most part when they're at bat or even in the game. But when they see a pitch that's exactly what they're looking for, they swing. The veterans are not any stronger than the young bucks. They may even be physically weaker, but they have experience and discipline to wait for a pitch that matches their criteria. They have the rare mental strength to lay off until they see that money pitch. When they see it, they often connect, and that's how you get into the Hall of Fame. And that's how you become a professional day trader. Most traders who fail will trade with an inverted profit-loss ratio like 1-to-2. This is extremely common among beginner traders. Unfortunately, when you trade with a negative profit-to-loss ratio, you are effectively setting the bar way too high. That is unsustainable, especially for a rookie. The sad truth is that many of the failed traders might permanently exit the market, having never realized that they were destined for failure because no one taught them about the types of pitches they should swing at. Also, no one gave them the mental conditioning necessary to wait and wait and wait some more until that special circumstance presented itself. Guardrail number 6. It's crucial, but not enough, for me to know my profit-loss ratio on a trade. I work hard to stick to those boundaries in the heat of trading. Changing risk parameters to accommodate a bad trade has not worked well in my experience. Cultivate discipline. A powerful way to reduce your trading risk is hidden in plain sight because we've all heard about it for years. It's discipline. In my trading courses, I spend a great deal of time stressing the importance of discipline. Many traders have come to me after taking courses from other educators and finding themselves stuck in a cycle of poor trading habits, trading losses, and disappointment. Having the knowledge of fundamental trading concepts is vital for them, but it's not enough. You must also be able to act and think like a successful trader. That means selling losers quickly and holding partial positions in your winners as long as possible. In order to help our traders at Warrior Trading improve their ability to be disciplined, we strongly urge them to do a minimum of 30 minutes of exercise and 15 minutes of meditation each day. I use exercise and meditation to help train my mind to cope with the stress that accompanies day trading. By forcing myself to do things each day, I'm practicing discipline. I'm forcing myself to tolerate a degree of discomfort. And I didn't choose just 2 activities at random to practice every day. Exercise and meditation help me stay grounded and sharp. When I'm in a trade, I must make hard decisions. I need to fight the urge to sell my winners too soon and hold on to my losers too long. By practicing discipline in other areas of my life, I strengthen the muscle memory and improve my ability to maintain composure while I'm in the high-stakes moment of trading. Practicing discipline is a way to condition my mind to become accustomed to the feeling of discomfort, because both risk and fear generate discomfort. Rather than look for ways to ignore or skirt around those feelings, I regularly train myself to withstand them and make sound decisions even during that discomfort. Many of the successful traders I know have a strict exercise regimen because it helps them with their trading performance. The whole point is not to deny or block out emotions in the moment, because that's impossible. Instead, it's to recognize these emotions and allow them to exist without acting rashly on those feelings. We'll talk about this more in Chapter 11, but one big benefit of journaling is that it helps you develop an awareness of the stress you're feeling while you're trading and to what degree it went beyond feelings and affected your actions during a trading session. It's called practicing discipline for a reason because it never ends. You might learn how to ride a bike or how to swim and can come back to it years later and you may still have the skill, but discipline is less of a skill and more of a muscle that you strengthen by exercising it regularly. And if you ignore that muscle, it will weaken and eventually atrophy. Even after years of trading, I still find myself occasionally giving in to my instinct to chase a stock for the fear of missing the move, or to sell a winner too soon, or even hold a loser a little too long. Every day when I trade, I have to fight against my natural instincts. Now, perhaps a few traders have a natural aptitude for the mindset required to be profitable in the market, but I believe for most of us, we really have to work for it. It took me years to become successful, and looking back, I realize it's because of the emotional obstacles that stood in my way. I had a solid understanding of stocks, chart patterns, trading strategies. I understood all of the fundamentals, but I kept falling into the cycle of big losers and small winners. It took a long time before I developed the self-awareness to realize what was causing those actions. Guardrail number 7. To maximize my ability to make the right decisions under stress, I try to exercise and meditate every day. It's one of the best ways to keep my discipline muscle strong. Different types of risk. We've discussed the measurement of risk in terms of profit to loss ratio and success rate. We've also looked at how you can reduce risk by cultivating discipline and sticking with the profit loss parameters you set before you make a trade. Now let's look at different types of risk and how to deal with them. Entry versus stop risk. This is the difference between our entry point in a trade and our stop or our max loss. Your stop loss should not be arbitrary or based on a hunch, but instead be based on a recent level of support or resistance on a stock. The detailed explanation of support and resistance goes beyond the scope of this book, but these are prices that act like boundaries. Therefore, they create very logical places to say if a stock breaks this boundary, it invalidates the basis for the trade. Volatility risk. This is the second type of risk we need to be mindful of. As I said in Chapter 7, day traders are hunters of volatility and managers of risk. Not only do we want to see volatility, we should not trade without it, because it's volatility that presents opportunities to trade quickly and for prices to swing significantly. We do love volatility, but only up to a certain point. Extreme volatility in the markets can cause larger losses than we had originally planned for. Breaking news has the potential to cause individual stocks or even markets at large to trade in extreme ranges. Instead of jumping into the market at such times, it's prudent to wait for the dust to settle before determining a potential trade opportunity. Exposure risk. There are 3 elements to a trader's exposure: share price, the number of shares you're holding, and how long you hold them for. It's also called the value of the position. Let's say I'm trading 1,000 shares of a stock that costs $10 per share, and I hold that position for 10 minutes. I'm not suggesting that we multiply 1,000 times 10 and then times 10 minutes to get $100,000 of risk or something like that. Instead, I use it as a rough sense of the magnitude when comparing different trades. Another aspect of exposure is what percentage of your portfolio is allocated to a stock. A long-term investor typically will not allocate more than 10% to any single stock. But contrast that with a day trader who may allocate most or even all of their account's buying power to one stock at a time. Then again, traders can mitigate that risk by holding shares for perhaps minutes, while investors sometimes hold positions for months or years. Stock halts. This risk can be a nightmare for day traders with large positions, especially if they've bought using leverage. The exchanges can halt trading at any time for a variety of reasons. There are market-wide halts that will happen sometimes if there's a technical glitch or a high-frequency trading algorithm has gone haywire. These halts are very rare. They may last for a few minutes, but they can stretch for hours or even longer. The more common stock halts are because of volatility or pending the release of material news. Volatility halts are sometimes called circuit breaker halts. If a stock rises or falls more than 10% in a 5-minute rolling period, the stock will be halted automatically for 5 minutes. This volatility pause gives traders a chance to analyze news, get their bearings, and slow down. When the markets are volatile overall, this type of halt is very common. Often it'll be because some news leaking about the company or even a rumor which causes a rapid move enough to trigger a halt. Stock halts due to pending news is one of the greater risks in trading. Stocks susceptible to being halted pending news can be stocks surging up rapidly for no apparent reason at all. In this case, it's not uncommon for the company to issue a statement regarding the price action and to address the rumors that may be causing the volatility. Although stocks can be halted at any time for pending news, typically companies release news when the market is closed. Another type of stock halt that can happen on any stock, but is more common with penny stocks, is a T12 halt. It happens when the exchange requests additional information from the company. This type of halt can last for weeks or even months. It's often related to a pending government investigation. Because penny stocks are sometimes used for market manipulation and fraud, a penny stock that goes up 500% on no news could be at risk of being halted pending news or on a T12. This is one of the reasons I avoid trading penny stocks. As day traders, we have to be mindful of the potential for stock halts and limit our positions on stocks that are at risk of being halted. Penny stocks are an example of this, but also are stocks trading on no news or rumors that have not been confirmed by the company itself. Stock halts are another reason trading on margin and leverage can be so dangerous. If you're trading on leverage and you got caught in a halt and the stock opens down 20%, it could cause a loss that could be somewhere between massive and catastrophic. The problem is that anytime a stock is halted, it can reopen at a much different price. The risk is that it could reopen far below your maximum acceptable loss. And when a stock is halted, you cannot buy or sell until it resumes trading. The reason a stock can open higher or lower from a halt is that while the stock is halted, buy orders and sell orders can change in response to news. If a stock is going up, sellers may pull their orders, while new buyers place orders to get in even higher. This creates an imbalance. If there are more buyers, the price will open higher. If there are more sellers, the price will open lower. Typically, stocks that halt while going up will open higher, and stocks that halt while going down will open lower. However, in the case of a T12, I've never seen a stock open higher. In the case of a halt pending news, the resumption will be entirely based on the market reaction to the news. Becoming great at being wrong. In Chapter 7, I talked about the importance of being a good loser. In our discussion about risk, I want to get more specific about loss in trading. When I speak with a trader who recently has experienced a large loss, one of the first things I tell them to do is to spend some time reviewing the trade that resulted in the loss. I always begin by asking the trader what their profit-loss ratio was when they entered the trade. And I almost always get one of the following responses. What's a profit-loss ratio? Now, traders in my community know what this is, but I frequently speak with people who have gotten their training somewhere else. Or they might say, I forgot to set a profit-loss ratio before I jumped in. Or maybe, I said a good one, Ross, and I can't believe how fast things went south and I just kept holding. Yep, deer in the headlights. We already talked about 2 guardrails I identified. I generally look for trades with a 2-to-1 profit to loss potential or better, and I work hard to stick to those numbers regardless of what my emotions tell me at the time. Those 2 rules alone have the potential to save you all kinds of money and grief, but we can save you a little bit more by adding the following. Guardrail number 8. I set and follow a max loss amount per trade and a max loss amount per day. Setting a daily max loss to be the same as my daily profit target, yet another number to have, is a way to manage risk. I did not put the profit target in guardrail form because it's not as crucial as the max loss, though it's still important. If I have a daily $200 profit target and I find myself down $200 on the day, I shut down my computer and walk away. But Ross, what if I'm super close to turning things around? What if things are looking promising so that I'm almost sure that I can make up some of that loss? After all, it worked for me that way last week. Blindly following rules shouldn't trump judgment. I disagree. Yes, they should. To put it more precisely, the judgment is in creating those rules. Although it's difficult to accept defeat, it's far more important to realize that once you have exceeded your max loss, your judgment is almost guaranteed to have become compromised. It is always best to walk away instead of attempting to trade in a compromised emotional state. Day traders don't have the luxury of taking time to sleep on it or grab some fresh air and think it over. The guardrails are built at the very places where most people veer off the road without them. About the max loss per trade, I typically set it at about 25% of my daily profit target. If I take a trade and the market suddenly turns against me, I take the loss. If I take 3 or 4 trades like that in a row and I lose on all of them, it's time to shut it down before things get worse. Now, I've gotten better at reading the writing on the wall and walking away sooner. But over many years of leading the community at Warrior Trading, I have found that some traders are very good at taking their losses, while others struggle to press that sell button and walk away. Some will even turn a short-term day trade into a swing trade by not liquidating the position at the end of the day. If you become one of those traders who is frequently down beyond their max loss, there is a solution. You can set automatic stop loss orders with your broker. If the price falls below your stop trigger price, the order will automatically execute and you will avoid having to manually press that sell button yourself. Even though it's difficult to hand over this aspect of trade management to a computer, it can make a difference for the account health of the trader who struggles to take losses at the predetermined time. This brings us to the next guardrail. Guardrail number 9. Sometimes I ask my broker to set a max position size, both in shares and dollar value, and a max daily loss on my account. I still use both to this day. Now, I give myself some breathing room, but this guardrail is to protect me from a worst case scenario. All sorts of things can happen. My toddler holding down the buy button on my keyboard until I've maxed out my buying power, a sticky key from a malfunctioning keyboard, or a moment of compromised emotional judgment. Even as an experienced trader, I feel more comfortable trading knowing that I have a safety net on my account. As my grandmother would say, it's always better to be safe than sorry. Using guardrails to protect against catastrophic losses is like an athlete trying to protect against injury. A sports injury not only ruins the day, but it can have long-lasting opportunity costs during your rehabilitation. A big trading loss can take a long time to recover from, both psychologically and financially. When you are trading, it's important to remind yourself that regardless of how you traded yesterday, last week, or last month, today is a new day. It's your opportunity to prove to yourself that you can follow the rules and stick to your trading plan. If you want to succeed as a trader, it's crucial that you can hold yourself to the rules of max loss per trade and max loss per day. Emotional hijack. Day trading is a career where you can make a catastrophic mistake and then keep trading moments later. You could take a 30,000 share position, lose $15,000, and then do it again 5 more times in a row. In just one day with a handful of trades, you could easily blow up your entire account. This is how a trader can become a gambler. Once you've crossed that line on any particular day, you've crossed the point of no return. You will have become a victim of what I call emotional hijack. This happens when a trade triggers a fight or flight response. It's typically, almost always, after a big loss, although it could be after a big win. I've developed an awareness of this phenomenon, and I've noticed that following a triggering trade, my heart will start pounding. My palms will get sweaty. I'll start to get tunnel vision. And in this moment, my brain subtly shifts from reason and logic to emotion and reflexive responses. I become pretty good at knowing my triggers, and I can typically catch myself before I cross the point of no return. If I experience the onset of an emotional hijack, I know to shut off my computer and not look at the market for the rest of the day. Because if I keep trading in this state, disaster is imminent. This is a state of mind where I will take trades where all the logic and reason would have told me to avoid, but I'll do it anyways. Later, when I look back at the damage, I'll ask myself, what was I thinking? Therein lies the clue of what's really happening. I was not, in fact, thinking during these moments. I wasn't calm and rational. I was fully in a state of emotional response. The way my distant ancestor might have felt while running from a saber-toothed tiger, in my case, my fear wasn't of death, but of loss, and that triggered the fight or flight response. In these moments, traders are simply gambling in a desperate attempt to avoid accepting loss. Developing an acceptance of loss through emotional conditioning is a critical part of scaling up any strategy. This is a process of experiencing small losses with no reaction and gradually scaling up the size of your trades until you can experience a loss that at one time might have been triggering. Your practice of discipline will also be crucial in your ability to pull yourself away from the computer at the earliest sign of an emotional hijack. Regardless of how much work you've done to prepare yourself for trades that might be triggering, it's important to recognize that we are only human. This is why it's important to have that safety net. Now, my safety net comes in the form of a max loss and a max position size that I have set with my broker as restrictions on my account. In other careers, like race car driving, if you crash your car into the wall, you're done until the next race. The very nature of that type of activity is that it gives you a period to reflect on the mistake that resulted in the accident. Or take sports, where we've all seen athletes smashing their tennis racket or golf clubs or pushing other players in a fit of rage. These are all forms of emotional hijack. The consequences are not good. They damage their reputation and they can cause costly penalties. In day trading, we don't have the luxury of a built-in timeout period after we make a mistake. So the ability to continue slamming those buy and sell keys can make the cost of an emotional hijack astronomical. In fact, one day of emotional hijack could be career ending if you don't have a safety net in place in the form of guardrails. Balancing your risk. In Chapter 7, we looked at how it's possible to have a 90% success rate and still lose money. It was because the first 9 trades yielded $100 of profit each, and the 10th was a $1,000 loss. This scenario not only points to the shortcomings at looking only at success rate, but also is an example of unbalanced risk. Guardrail number 10. I never want to have one trade weighted so heavily with risk that it has the power to erase more than 1 or 2 previous winners. It's true that even if that big final trade had a proper 2-to-1 profit-loss ratio, risking $1,000 to make $2,000, it still would have been a poor decision because the risk on that one trade far outweighed the average risk on all the others. Many traders, including me, will adjust our risk parameters throughout the trading day based on our performance and to adapt to different market conditions. This is a common practice used to amplify profits on days when trading is good, but also to reduce losses on days when trading is difficult. The trick is to adjust in relatively small increments, so the impacts of our winners and our losers don't have such a strong effect on our overall performance. For example, I may have set a max acceptable loss on the first 6 trades at $100, but based on the results of those trades for the next trade, I may increase my risk to $150, or I might decrease it to $75. I would not make a drastic change to my risk parameters in the middle of a trading session. Many traders may actually experience a great day up until they decide they're on a hot streak and swing for the fences. They take a high-risk, unbalanced position on what they think is a perfect setup, and if they lose on that high-risk trade, they may give back their entire profit from the day and go into the red. Talk about a triggering moment. That is not only a disappointing financial loss, but what's even worse is the loss of confidence that has the effect on your emotions. This can quickly escalate into what's called revenge trading, a cycle of increasing your risk with larger and larger losses. To avoid the situation entirely, a trader has to balance their risk across all trades. If that final trade turns out to be a loser, it should not ruin your entire day or your psychological control over future trades. Just as you can have a success rate of 90% on a day and still end red, the opposite can happen. You can have a success rate of 40% or lower and be green. The different outcomes result from whether or not a trader is following their risk reduction guardrails. Picking good stocks is just as important as we'll see in Chapter 10, but it's not as important as managing your risk on every single trade. You should focus foremost on your profit-loss ratio and your max loss on each trade you take. The many faces of fear in trading. Fear is a natural emotion, and we've all experienced the straightforward version of it. For example, an aggressive dog lunging at us will elicit a primal fear. With day trading, it's different. When we're trading, things might seem calm. We're in a comfortable room, looking at a monitor, sipping a latte with no angry animals in sight, but appearances can be deceiving. Experienced day traders are intimately familiar with the many manifestations of fear that accompany every trading session. Let's review them. Holding losers too long. The most obvious form of fear is the fear of financial loss. Many beginner traders and most failed traders will experience the tendency to hold their losers too long. The fear of loss is directly behind this behavior. Why do traders hold losers too long? It's because a trade is not a loss until you press that sell button. There's always the chance, however remote, that the price could pop back up if you had not punched the sell button. The fear of making the loss real keeps you in the trade. It makes you think of finding a way to turn the trade around instead of just acknowledging that it's a losing trade, taking the loss, and moving on to the next one. The reality is that the small losses are not a big deal, but a trader in an emotional state does not think that way. Sometimes a trader will make a bad trade worse, not just by waiting, but by averaging down. In other words, they will add shares at a lower price, which reduces their average cost basis. This typically results in even larger losses when it's not part of a strategy that involves scaling in and out of trades by averaging. I've worked with traders who have set a $200 max acceptable loss on a trade, but when they were down 200, instead of simply cutting the loss, they decide to add more shares in the belief that they could trade their way out of the loss. In reality, these trades often end up with losses of $1,000 or more. In hindsight, it's easy to say that the right thing to do was to simply cut the loss at minus 200 and follow the rules that you made for yourself. But unfortunately, in the heat of the moment, emotions can easily take control and your rational thoughts and plans get thrown out the window. The irony of this behavior is that the action that was based on a fear of loss actually resulted in the trader taking a larger loss than if they had simply followed their trading plan. The second most important skill for a new trader to learn is to cap their losses. The most important skill is to create and follow a trading plan, regardless of emotions in the moment. Selling winners too soon. If you enter a trade that has a good profit potential and fits within your trading strategy, the last thing you should want to do is sell the trade before it's had a chance to work. If you're up 10 cents a share on a trade that has the potential to make 50 cents a share, there's no reason to sell it, but then you sell it anyways. You've given in to the most counterproductive impulse. So why do so many traders sell their winners too soon? Again, it's because the fear of loss has guided their decisions. It's the fear that the small winner turns into a loser that convinces us just to press the sell button. Just as a loser isn't real until you press the sell button, a winner isn't real until you've hit the sell button and locked it up. In short, we feel happy to have locked up some profit, even if a small amount. But it's a bad habit to get into because you're conditioning yourself to cap your winners. We got to do the exact opposite. We have to cap our losers and let our winners run. Capping your winners will reduce your profit-loss ratio, which will then require higher accuracy in order to be profitable. When you sell your winners too soon, you're setting the bar for success higher than it needs to be. I can recommend an excellent book to you called Quit by Annie Duke. She's made millions as a poker player and has written extensively about decision making. In that book, she talks about a study that was done about taxi drivers. They had a lot of data from about 2,000 drivers in New York City relating to when drivers picked up customers, how much their rides were worth, and many other details. What they discovered was that taxi drivers did not make good decisions about when to keep driving and when to call it quits for the day. Annie Duke writes that instead of maximizing their driving time when their fares were plentiful and minimizing their unproductive time, they were likely to quit early when the demand was high for their services, and when there were few fares, they would work the full 12 hours, wearing themselves out driving around for little benefit. The researchers asked the drivers how they made the decision to keep driving or quit. It turns out the drivers set a daily goal for how much they wanted to earn. That number took over decision making. If they hit that number early in the day, great, they would call it a day. If business was terrible and they weren't anywhere near that number, they would just keep driving. But it gets better. Annie Duke said the researchers calculated that the drivers would make 15% more income if they worked the exact same hours but allocated those hours based on demand. In fact, if drivers chose a heuristic that was random, like they were working the same number of hours each day regardless of conditions, they would have made 8% more than with the strategy they were using. Annie Duke's book and this taxi driver study particularly resonated with me because the parallels are striking with day trading. To be a successful trader, you need to cap your losses, as we've discussed earlier. That means on a day when the market isn't hot, rather than grinding it out and fighting hard to hit your daily goal, walking away. The longer you grind it out, the more susceptible you become to decision fatigue. When the market isn't in your favor, it's simply not worth trying to fight against the headwind. But on the other hand, on a day when the market is hot, if you hit your daily goal in the first 10 minutes of trading and walk away, it could mean you're leaving an incredible amount of profit on the table. Typically, on my top 10 trading days each year, I exceed my daily goal by at least 4 times. In other words, if my daily goal is $5,000, my top 10 trading days will be in excess of $20,000 each. In this example, if I stopped trading on each of those 10 days when I hit my goal, I would be leaving $150,000 of profit on the table. I would have only $50,000 instead of $200,000. This is a significant difference. In fact, my top 10 trading days typically amount to nearly 20% of my profit for the entire year. There are 250 trading days each year, and yet just 10 have the power to dramatically change my year. This means as traders move from beginner to intermediate and then to advanced, a critical skill they need to learn is how to throttle up in a hot market and throttle down when the market is cold. In studying my trades, I've also found that my best days tend to be clustered together. This is because the overall market is hot, not just one stock. The same pattern is true with my worst days. These losers are typically clustered together as I find myself over trading during a cold market. However, it's not uncommon for hot and cold days to be back-to-back during choppy markets. This means I may need to throttle up and back down quickly from day to day in response to market conditions. Guardrail number 11. I trade the market I'm in, not the market I want to be in. I throttle up when it's hot, I throttle down when it's cold, and I do everything possible to minimize drawdown, so each day I come to the table confident and ready to perform at my best. Growing up in New England, I've always been a big skier. Conditions in New England regularly are icy, wet, mushy, and we rarely get good powder. Experienced skiers will often tune their skis to the conditions they're in by applying different types of wax and making sure their edges are sharp. If they're really dedicated, they may even have different sets of skis ready to match different conditions. This approach is not too different from tuning or adapting a proven strategy to different market conditions. Throttling up or down is the best way of trading the market you're in. Besides trading longer on a hot day and trading less on a cold day, I will adapt my share size and position management to suit market conditions. When it comes to share size, as we've previously discussed, it's important to manage risk fairly evenly across a trading session. However, in a hotter market, it makes sense for me to scale up share size to trade at the upper range of my limit. Trading at the edge of my comfort zone during a hot market has always been the best way for me to maximize on the opportunities. After all, a hot market is not the time to be trading conservatively with small size relative to what's typical for you. If I decide to expand the upper range of my share size limit, I will only do that through a gradual period of small increases. If currently I max out at, let's say, 10,000 shares, and I want to move my upper limit to 15,000 shares, I may increase by 1,000 shares a week until I reach 15,000 shares. This allows me time to acclimate to the larger losses that will come from these bigger positions. If I'm able to get comfortable with trading at 15,000 share positions, then I can begin to work my way up towards 20,000 shares. However, at some point, there will be the inevitable drawdown as the market cools off. This is when I ease back down to 10,000 shares until things pick back up again. The challenge here is going from 10,000 shares one day to 20,000 shares the next day, as the market can shift from hot to cold quickly. This type of large fluctuation in share size should really only be reserved for the most experienced traders. As we discussed earlier in this book, the risk here is that you have 5 or 6 great days trading with 10,000 shares, and then just through sheer bad luck, on the day you go up to 20,000 shares, you take a huge loss that wipes out the previous week of progress. Besides adjusting my share size to market conditions, I can also adjust my position management. This is the approach that I take to scaling in and out of trades. Most beginner traders will have one entry and one exit. There's no scaling. But as a trader gains experience, they will often experiment first with one entry and 2 exits. This is called scaling out of a position. Rather than selling the whole position when you hit your profit target, you choose to sell half and keep the rest. At the same time, this is where a trader would move their stop loss to protect the profit on the remaining position they're holding. During a hot market, let's say I bought 5,000 shares of a stock at $10 with a profit target of 11. My stop would need to be $9.50 in order to have the 2-to-1 profit to loss ratio. But if the stock goes to 11, rather than selling the whole position, I may choose to sell just a quarter of the position, or I may hold the entire position until a clear exit indicator forms. If the stock goes to 12, 13, 14, or $15 a share, my gain will be substantially higher. The most conservative strategy that most beginner traders will follow is to sell the whole position. That's safe, and there's nothing wrong with playing it safe and taking profit. Though it's not the optimal way to trade in a hot market, a beginner trader isn't going for peak performance yet. They're just trying to keep their head above water and maintain consistency. This comes back to the philosophy and the mantra of get green and shut it down. In a cold market, I will be much more likely to sell the full position or certainly take half off the table when I hit my profit target rather than risk losing the gains. The more I see stocks failing to hit my profit targets, the more likely I'll be to sell even sooner. But on the other hand, when I repeatedly see stocks outperforming my price targets, I'll start to hold longer. Market strength and sentiment becomes a bit of a self-fulfilling prophecy. If traders think the market is cold, they trade conservatively, thus keeping the market cold. If traders think the market is hot, they trade aggressively, thus keeping the market hot. Changes in hot and cold environments, however, can happen quickly as traders rush to adapt to the new environment. The subtle change in position sizing and position management between a hot market and a cold market can help maximize profits and minimize drawdown. Being able to adjust your strategy in real time is the goal for any trader, but it requires a deep connection both with the market and your awareness of your own emotional state. This is what we call flow state trading. Now, you may notice a contrast between the mantra of get green and shut it down and the philosophy of leaning in and throttling up when the market is hot. There is a right time for each approach. The get green and shut it down strategy is the way to go when you're a beginner trader, if you're in a tight financial situation where you cannot afford any mistakes, or when you've recently experienced a big loss or a string of red days. In all 3 cases, your emotions tend to run high and your confidence is low. This is when your guardrails must be the narrowest. Every day that we trade, we're doing one of 2 things. We're either leaving money on the table or we're giving back profit. It hurts less to walk away with profit in your pocket, knowing you left some money on the table, than to give back profit. In fact, I find that if I give back more than half of my profit after hitting the daily goal, that by itself can become a trigger for emotional hijack. As a beginner, it's super important to protect your emotional state. This state is similar to momentum. As you build consistency, you build confidence, and it becomes a positive feedback loop. However, one big loss can throw you off that positive feedback loop and send you right into a negative feedback loop of emotional hijack and poor trading decisions. Experiencing a large drawdown can have 2 costs. The first obvious cost is the money you lost in a trade, but the less obvious second cost is the opportunity cost during your period of trading with low confidence. The safest way for a beginner to trade is by getting green and getting out. Now, this isn't forever, but it is an important phase. You need this period of extreme discipline to build a track record of success. That track record becomes your source of confidence when you experience your first drawdown. Once a beginner trader has successfully recovered from their first drawdown, they are ready to work on trading longer when the market is hot. This means confronting the risks that come with trading longer in the day, including decision fatigue and the risk of becoming emotionally triggered by giving back earlier gains. This is getting into the intermediate and advanced phases of trading. Sometimes I think of guardrails as training wheels. They are an important tool to learn to trade safely that builds confidence and helps avoid bad experiences. But then again, you won't win the Tour de France with training wheels. At a certain point in your growth as a trader, you'll have the discipline and experience such that you can pull back on many of the tightest guardrails. At this stage, you will have a level of emotional growth and self-awareness that you'll know when to walk away before a bad day gets out of hand. The fear of missing out. A less obvious form of fear is the fear of missing out on a big move in the markets. You may suddenly see a stock start to jump up on what may appear to be breaking news, or you see a technical indicator like a reversal taking shape, and it's easy to feel inclined to jump into the market out of fear of missing out. But that fear has guided your decision into an unplanned trade. You may then purchase at a price that's too far away from your stop, or take more shares than your risk tolerance allows. In seconds, you've made a decision and broken your rules. When these trades go badly, they will often result in taking a larger loss than your strategy and rules allow for. When I speak with traders about a massive loss, they often say it happened so fast. In reviewing my own trading performance, my biggest losses were on spontaneous trades that I jumped into on an impulse. I saw the market starting to move, and I jumped into a stock without fully analyzing my risk. When emotions guide your decisions, big mistakes are common. To be clear, there's nothing wrong with a quick decision. In fact, it's important to be decisive. But when you're quick to decide and you don't follow your rules, things can get expensive. Trader rehab. This topic is not precisely a fear, but it's so wound up with emotions that I want to bring it up here. Even after all my years of trading experience, I'll occasionally suffer a big red day, or what's called a drawdown. After a series of red trades or red days, I realized pretty quickly that what I'm doing isn't working. Maybe the market went cold. Maybe I wasn't quick enough to ease off the throttle. Whatever the reason, the first order of business is to stop the bleeding, and I check myself into what I call trader rehab, which is not a physical place, but a state of mind where I return to strict guardrails. Although I have an entire course that discusses the program of trader rehab, for the purposes of this discussion, trader rehab for me consists of three primary things. Number one, I set a maximum share size with my broker. Typically, I will set a maximum share size with my broker, but I set it fairly large to give myself some breathing room. During trading rehab, I make it very restrictive, so I cannot take big size. Number two, I will also reduce my maximum daily loss to about half or even a quarter of my regular max loss. Depending on how I'm feeling, I may set that number as a reminder to myself, or I may actually call my broker and ask them to enforce it on their back end. That way, it'll happen automatically for me, and I don't have to worry about another big red day while I'm in trader rehab. Number three, if I'm in a particularly bad drawdown, I'll just take one trade a day for 5 days. My goal here is to have 5 small green days in a row. That means I'm going to be very picky about which trades I'm willing to take each day. Now, if I have a red day, that's okay too, but I have to cut the loss as soon as I realize the trade isn't working. Even though the first 5 days of intense trader rehab may only produce a small profit, the purpose is not about making money. The purpose is about putting space between me and the big loss. It's about regaining my confidence. Every time I do a period of trader rehab, I'm impressed by how much better I feel 4 or 5 days into it. But as we discussed before, there is an opportunity cost associated with being in trader rehab. This is a reminder to do everything possible to avoid getting myself in these situations in the first place. I find that if I widen my guardrails coming out of trader rehab too soon, I risk what I call stair-stepping down in my trading account value or my equity curve. That means after a period of an ascending equity curve, where my profits were going up, I have a drawdown where the profits go down. Then during trader rehab, I go sideways for a couple of days, and then if I have another big loss, I'm taking another step down, which makes the chart look like I'm having a staircase going down. That's not okay with me. In order to prevent an extended period of decline, I keep those guardrails firmly in place on my account until I have recouped about half of my drawdown. By that time, almost invariably, my confidence will be back and I'll almost certainly be in a better position to increase share size and the number of trades I'm taking each day. The hunt for the Holy Grail. In Chapter 2, I described the hunt for the Holy Grail in the form of an automated system to find and trade the perfect setup or pattern. There's another type of Holy Grail which involves jumping from one strategy to another or one technical indicator to another. Some traders will spend a tremendous amount of time and energy searching for the perfect combination of indicators and strategies in the hopes that this combination will give them a ticket to winning trades. Of course, it makes sense to be on the lookout for profitable strategies, but that's not the motivation for these traders. Just below the surface is a deep fear of loss. It's a desire to search endlessly, and it truly is endless, for that perfect so-called strategy that will prevent them from experiencing any more losses. But like the Holy Grail, it doesn't exist. You can identify traders with this fear because they'll work to create an automated trading system, as I did early on, or they'll try to mirror trade someone else, or they'll jump from strategy to strategy. Unfortunately, this quest often continues until their financial resources dry up and they quit. The way to counteract this behavior is to be aware of it and to accept that loss is an inseparable part of trading. Kids will join Little League and soon realize that strikeouts are simply part of the game. Legendary players still strike out, but they're remembered for their composure under stress and their ability to execute on their game plan despite that stress. They are mental role models. The real Holy Grail is to have self-awareness of stress and the discipline to follow your rules regardless of the momentary urges. Now it's time to shift from abstract concepts of risk, fear, and discipline and learn how day traders can get an astonishing amount of information from one glance at a screen. The trick has to do with candlesticks. Chapter 9. Introduction to Candlesticks. When day traders sit down and turn on their computers, they look at several screens of information. One screen shows them gappers, or stocks that are set to open the highest relative to where they closed on the previous day. Another screen is a real-time feed of news related to selected stocks. More than one screen will be devoted to looking at charts of individual stocks in the form of candlesticks. A stock chart is a visual representation of the historical price of a stock. Stock charts provide us with a context so we can quickly understand the current price of a stock relative to previous prices. The most commonly used charts for day traders are candlestick charts. Candlestick charts were first used in the 1700s to track price changes of rice in Japan. They are an efficient way to display a lot of information, especially when you view multiple candlesticks over time. We're going to discuss some basic terminology of candlesticks in a moment. If you're looking at a daily chart that's displaying the last 90 days, you will see 90 individual candlesticks. On that chart, each candlestick represents 1 day of trading. If you're looking at a 1-minute chart, then each candlestick represents 1 minute of trading. Charts can be set in almost any time interval a trader desires, but the most common ones for candlestick charts and for active day traders are daily, 60-minute, 15-minute, 5-minute, and 1-minute intervals. I set up my monitors to show daily, 5-minute, and 1-minute charts, and I even have a 10-second chart for when stocks are moving really quickly. What the candlestick reveals. A single candlestick provides us with 4 pieces of information about the price of a stock within the specific interval, like the daily, 15-minute, 5-minute, 1-minute, and so on. The 4 pieces of information we learn from the candlestick are, number 1, the high of that period. The 4 pieces of information we learn from an individual candlestick are, number 1, the highest price traded during that period. Number 2, the lowest price traded during that period. Number 3, the price at the open of the period. And number 4, the price at the close of the period. When I say open and close of the period, I mean the beginning and the end prices for that one candlestick, for that one interval. Now, investors are accustomed to thinking about the open and the close in terms of where a stock began and ended trading for the day. And while day traders don't discount that, we often are looking at the open and the close as it relates to an individual candle on the chart that we're looking at. When you're looking at an individual candlestick, The thick center that's usually shaded in is called the real body, or the body, and the thin lines that extend up and down are called the upper and lower candle wicks, or simply shadows. On your trading monitor, candles will come in two colors. A green candle means that the opening or the initial price for the period was at the bottom of the candle's body, and the close for that interval was at the top of the body. This means the stock price went up during that period of time. The opposite is true of a red candle. Now, besides the 4 data points, we can also draw conclusions about market sentiment based simply on the shape of the candle. Multiple candlesticks lined up together can begin to form familiar chart patterns with names like flags, wedges, or even something called a dead cat bounce, which you'll learn over time. With a little practice, you'll be able to glance at a set of candlesticks, and within a few seconds, you'll be able to understand how the stock has been behaving over the different intervals like the daily, the 15-minute, the 5-minute, the 1-minute, and so on. Let's talk about some of the most common types of candlesticks that you'll see. Doji candlesticks. A doji candlestick has a very small real body, meaning that the open price and the close price are nearly the same. We can infer from this candlestick shape that there is a momentary standoff between buyers and sellers. If this candle happens on heavy trading volume, it tells us that there is a battle going on at that price. Sometimes a doji will also have a long upper or lower candle wick. The price suddenly moved up or down, but then returned quickly to more or less the same price as the open. This means the move was not sustained. In general, a doji candlestick represents indecision in the market. When a doji candle occurs at the top of a very strong move of say 5 to 10 green candles in a row, the indecision reflected in the candlestick shape can signify a potential reversal. Dojis that happen during a period of sideways consolidation are less important to us because sideways consolidation is already reflective of indecision. Be patient. Now, if all of this feels overwhelming at first, please give yourself some time to absorb it. Learning about candlesticks and charts is very much like learning a new language. At first, none of it makes sense. Then you learn a few words, and that is progress. The problem is that you then need to understand how individual words fit together into sentences, how individual candles form candlestick patterns. Soon, you're overwhelmed because the native speakers are talking full speed and you recognize maybe only 1% of what they're saying at first. It can be daunting, but then you realize even little kids can pick up a new language if they're given time. It's the same with understanding the language of the financial markets. At first, it's a lot to recognize doji candles versus all the other candlesticks. Never mind how they fit together into a pattern, but you need to trust me on this. The human brain is great at recognizing complex patterns if given time to see them again and again. So at this stage, simply listen through my descriptions and absorb whatever makes sense. Plan on going through this material again a few times because each time you'll get a deeper understanding. Bottoming tails and topping tails. When you see a candle with a super long upper wick or a lower wick, these are called a topping tail or a bottoming tail candle. These candles can signify a potential reversal in price. To unpack what happens in a typical topping tail candle, let's imagine we have 3 or 4 big green candles in a row. The next candle, our topping tail, opens and begins to move higher and then suddenly starts to shoot up very quickly. But by the time it closes, it's back down only a little above the open. There had been a continuation of the upward trend, but then followed by a very quick reversal around the middle of that candlestick interval. These sort of candles with long upper or lower wicks are some of my favorite indicators of potential reversals. I rely on these candlestick patterns to tell me when to exit a winning position or when to begin to look for a reversal to time a new trade. Hammers and inverted hammers. Like dojis and bottoming tails, the hammer candlestick will really only have significance when it occurs in the context of a long downtrend. A hammer candle occurring after a series of red candles will always have a smaller real body with a longer lower candle wick, making the candle almost look like a hammer or a mallet. It's often said that a hammer candle is hammering out a new base. The long bottom wick indicates a sell-off in that period, Prices dipped down, but then buyers quickly took the opportunity to jump in and bring the prices back up. Now, a hammer candlestick does not always mean the downtrend will reverse. Confirmation of the reversal will come when the next candle breaks the high of the hammer. This is called a candle over candle formation. An inverted hammer only carries significance when it occurs at the end of a long uptrend. The inverted hammer has a long topping tail with a small body. The long topping tail indicates a surge of buying that was quickly reversed. This suggests indecision and a battle that has begun between the buyers and the sellers, and in this case, it was won by the sellers. We often call an inverted hammer a shooting star, and the confirmation of the reversal will be if the next candle continues lower. When we're watching stocks trading in real time, we can see the actual formation of these long candle wicks. They often appear as a final burst of volume and then a quick retracement, a powerful snapback as the reversal begins. I think of it as a rubber band getting stretched out and then releasing. Again, this will all make sense over time, so just absorb what you can. Long body candles. The final candlestick shape I'll cover in this chapter is called the long body candle. As with every other type of candle, it can be red or green. A long body candle that is green opens and surges up without ever looking down. These candles close at the high and are an indication of extreme bullish sentiment. As day traders, we always want to be holding a stock while a long body candle and the bullish sentiment is forming. But we must be cautious when considering buying after a long body candle. If we do buy at the top of a long body candle, we're chasing a large move. It's usually better to wait for a pullback opportunity if we want to trade with the trend. As you learn more about patterns and technical indicators, you'll discover how we identify pullbacks and many other type of opportunities on a candlestick chart. Now, a long red body candle shows the opposite, extreme bearish sentiment as the candle opens and sells off during the entire period. After a series of several long body candles in a row, there's a high likelihood of a reversal and a change in sentiment. Individual candlesticks come in a variety of shapes with different meanings. Then, when you consider several candles in a row, you get so much more information. You can receive yet even more insights when you learn how to look at a candlestick chart for a specific stock over several intervals. As I mentioned at the beginning of this chapter, I always have charts open that show the daily, the 5-minute, the 1-minute, and the 10-second charts. When I see a pattern forming on one time interval, say the 1-minute chart, I will look at a larger time interval, like the 5-minute or the daily, to see if there's a reason I should avoid the trade. If I don't see any reason not to take the trade, then I would say we have what's called multi-time frame alignment. Candlestick shapes and patterns are just the beginning of technical analysis. To fully interpret price action, we must look at volume, which is the number of shares traded. High volume and low volume during a pullback period provide deeper insight into the shape of the candlesticks and the level of interest among traders. To further interpret candlestick charts and price action, many traders will rely on popular technical indicators such as moving averages, the volume weighted average price, moving average convergence divergence indicator, and the relative strength index, among others. Getting into the details of each of these indicators is beyond the scope of this book, but it's not difficult to understand. Most technical indicators are lagging in nature, meaning they require price changes before they create signals. Therefore, looking directly at candlesticks forming on your charts will provide you with the most real-time view of the stock. It's the traders who learn to read the buy and sell signals directly on a candlestick chart who will be the most successful. I assure you, the signals are there. If you don't see them yet, it's just because your eye is not yet trained. But the human brain is astonishingly good at recognizing patterns. Just think about all the different faces you can instantly recognize. Think about how you can interpret facial expressions from moment to moment. Once you apply that powerful brain of yours to pattern recognition of candlestick charts, soon you'll be seeing stock movements in a whole new way. So far in this book, we've talked a great deal about what it takes to be a good trader in terms of knowledge, skills, emotional awareness, and discipline. But you may also be wondering what it takes for a stock to be a good candidate for day trading. We'll talk about that in the next chapter. Chapter 10, Finding the Right Stocks to Trade. As I hope you've gathered by now, by far the biggest determinants of your day trading success are the elements in your head: your knowledge, your discipline, your attitude, and ability to control emotions. It's no accident that I used the first chapters of this book to cover those key topics in depth. Now it's time to bring in some other concepts. Even if you've never day traded, you may know day traders look for particular stock trading patterns. We focus on the candlestick charts of various intervals until we see something that we think could be worth taking a position in. It would be a mistake to think that day trading is all about the pattern, though if you watch me trade, the candlestick charts and the ever-changing patterns are what's most visible on my screen. Chart patterns are indeed important, but the pattern itself is not a day trading strategy. It's just a pattern. Similar chart patterns can occur on really any financial instrument, from commodities and forex to cryptocurrency. A day trading strategy involves much more than just a pattern. It includes the following: your maximum acceptable loss, which we already discussed extensively in Chapter 7, but both in terms of max loss per trade and overall max loss per day. Your daily profit goals. You'll need to know your profit target per trade and your overall daily profit target. The share price you like to trade. I like to focus on stocks between 2 and 20. Although occasionally I'll trade something outside these parameters, it's important to have a focus. The time of day you'll trade. As we discussed in Chapter 3, the vast majority of trading happens between approximately the hours of 7:30 a.m. and 11:30 a.m. Eastern Standard Time. And then we have the question of which stocks to focus on. This is the element we'll cover in this chapter, starting with the next guardrail. Guardrail number 12. I've found that trading the right stock is so much more important than trading the right pattern. To put it another way, if you trade the wrong stock, even with a great pattern that's made you money in the past, most likely you will find the stock is unpredictable, you'll be super frustrated, and you will lose money. So if the right stock is more important than the right pattern, what makes a stock great for day trading? Let's go through 6 components to the answer. Strong stock component number 1, a stock that's volatile right now. You already know that as day traders, we are hunters of volatility and managers of risk. We've covered many risk reduction strategies already, but now let's shift the focus to volatility. As we discussed in Chapter 8, how fear and risk are always present when we trade, it's also pretty obvious that greed is a potential motivator, especially with untrained and undisciplined traders. These are the people who are guided by gut feelings instead of a trading plan that involves profit-loss ratios, profit targets, maximum acceptable losses, and so on. No matter how high a stock has gone, they'll make a case for why it could go much higher, and it's okay to chase it. What turns all these emotions into volatility in a stock is typically some sort of catalyst, usually in the form of news. A sector I particularly enjoy trading are small biotech and pharmaceutical companies. A headline that the FDA has cleared a new drug or device can be a big deal for these companies. But a news catalyst can also be an unexpectedly positive earnings report, a new contract, or really anything that investors perceive to have a positive effect on the long-term future value of the company. As I've said before, I'm not interested in stocks that might move, that are, quote, primed to move, or are, quote, significantly undervalued. I only focus on stocks that are already moving. That typically means they're already up 15 to 20% or more since yesterday. There is a certain conventional wisdom about investing that says we should buy low and sell high, but that's not momentum day trading. Instead, as momentum day traders, we buy high and we sell higher. The benefit of buying high is that the stock is already moving substantially, which spares me the uncertainty about which stocks that are currently priced low might reverse. Once I buy, if the stock continues to go up, I'll sell higher. Then, if a new pattern forms, I may buy it again, even with a somewhat higher position, with the goal of selling it yet again even higher. A strategy that I use to mitigate my risk as these stocks are moving higher is to begin to scale down my share size. That way, I can continue to participate in the upside momentum without risking giving back all my profit. Another bit of conventional wisdom says that avoiding losses is a good thing. Although I agree with that statement in general, I use loss to my advantage. I will keep buying and selling higher on a stock that has strong momentum until I reach my first loss where the stock did not continue higher. Why would I do that? Because it means I was able to ride the stock as far as possible while carefully adjusting my risk exposure. If I don't trade until I hit my first loss, I could be leaving a lot of opportunity and a lot of profit on the table. The best opportunities in the market are the ones that are the most volatile with the highest relative volume. We'll discuss more about relative volume later in this chapter, but that combination of volatility and volume leads us to our next guardrail. Guardrail number 13. Each day when I sit down and I'm looking at potential stocks to trade, I ask myself, is this the strongest stock in the entire market today? You may have learned in school that the first person to cross the Atlantic Ocean nonstop by airplane was Charles Lindbergh. Who was the second person? No one is taught that, but it was Amelia Earhart. It's the same with stocks on the move today. Today's strongest, most volatile, most obvious stock gets flashed across screens of traders worldwide. It's the top of the list by definition in the number one spot. It gets the most attention, and that gives us the volatility and the relative volume that we seek. Now, it's important to keep in mind that sometimes the top number one gainer, the most obvious stock in the market today, is not a stock that I would like. Sometimes it'll be too expensive, over $20, or it could be too cheap, under $1 a share. Other times, the top gainer will be a stock that's just been acquired. When a stock is a buyout, the value becomes fixed at the buyout price and volatility disappears. When a stock is a leading gainer, but is not an obvious stock for retail traders, then the second or third leader may end up taking the spotlight. However, on days where the number one top gainer is a stock that perhaps many retail traders do like, but that I don't, I have to be very cautious about trading other stocks because they will be in the shadow of the most obvious gainer. That means they may not experience the same level of volatility, the same relative volume, and the trades may not perform as well. This means being very dialed in with the human emotions in the market of what other traders think is the best stock today. When that aligns with the best stock for my strategy as well, that's when things get exciting. Now, besides knowing which stock is the strongest today, you should be mindful of whether the overall market is hot or cold. On some days, it seems like you could throw a dart at the stock listings in a newspaper and you'd likely to hit a stock on the move. But other days, it seems there's very little that wants to move, and where even the best moving stock is anemic. In periods of colder markets, I scale back my expectations for making great trades. I try to lay low and stay patient for the next hot streak. Strong stock component number 2, fear in the market. Disciplined traders usually see fear in the market as an opportunity. Remember from our earlier discussion that stocks don't move by themselves or even based on the news. They move when traders react to the news. FOMO, or the fear of missing out, is a huge driver of stock market volatility. Traders watch that strongest stock of the day and may see that it just ripped up 50% or more in a matter of minutes. They know someone that just sold that stock for a profit, and then they see it go even higher. It's a breeding ground for irrational trading. It's even happened to me. Someone in my chat room will tell me they made $50,000 on today's big move. I pretty much cannot help but feel some degree of FOMO over that. But I can control whether I give in to FOMO. If I emotionally smash the buy button thinking only about profit, that's a form of emotional hijack. On the other hand, if the stock is forming another one of my favorite chart patterns, we could see a continued move higher. This could be the opportunity to capitalize on FOMO in the market without falling victim to it myself. This is like walking a tightrope. You can quickly fall if you get unbalanced by adding to your position too high, by getting stubborn, or by ignoring what the chart is telling you. Fear of loss is a powerful motivator for traders. It makes people capitulate and buy stocks that are way too high, and it also makes some people panic and bail out of positions. They may feel they've bought too high and now they have to throw in the towel out of fear or anger. FOMO truly does fuel volatility. The approach that works the best for me is to keep trading as a stock is moving up. But once I give back about 10 to 15% of my profit on the day, usually when I have that first loss, that's when I shut it down before I give back any more. If I find myself in a position where it appears that I bought too high, I ruthlessly cut my loss. I still need to preserve the profit that I've made on the day after all. This is the mark of a disciplined trader. Strong stock component number 3, greed in the market. You can think of greed in the market as one-day-old FOMO. It's common for one stock or another to make eye-popping moves within a single day. A hot stock in a strong market can move by hundreds of % in a day. Not only does that stock make it to the top of the leaderboard that day, but the effect can continue for days later. Some traders think, I can't believe I didn't get any of that run. I was right, I was watching it the whole time, but I didn't take a trade. Or I just gave back half my gains on the month by getting in too high. When this happens, there will be some traders who will try to make up for it tomorrow. That fear and greed is so strong, it spills over to the top gainers on the next day. Politicians refer to the coattail effect, where one strong candidate will sometimes have the effect of sweeping other candidates along too. I see that happen in the stock market. Sometimes when one stock is strong, I'll see 3 or 4 others that start to pick up. I call it sympathy momentum. It's not that the fundamentals of those other stocks have suddenly changed, but it's the emotion and the sentiment that has shifted. Traders are looking for the next big move. Now we see this across all sectors of the market, but the biggest percentage gains are on the lower price stocks. In analyzing my trading history, I've noticed that typically all my big winners are very close together. But unfortunately, the same is true of my losers. The power of 10 to 15 cents. I speak with many successful traders, and I've noticed a phenomenon that's happened even to me. They'll tell me how they had a good day of trading and then decided they were done for the day. Then, half an hour later, or maybe more, they went back in for one more trade and they lost all their profit for the day. This happens because each day we have a reservoir of willpower, and that tank was reading 0 when they went in for the last trade. It's fine and even necessary to trade as aggressively as you can, but it's even more important to know when to pull out your profits from the market and to walk away. Guardrail number 14. My goal each day is to pull 10 to 15 cents per share out of the market as a minimum. You may be scratching your head at this one. It doesn't sound like much of a goal, right? But believe me, it separates the professional, consistent, successful traders from all the rest. If you can do even just 10 cents per share per day consistently, that is something you can scale. When you're trading with 100 shares, that $10 of profit might not seem like much of an achievement. But at 1,000 shares, we're talking about $100 a day. And with 5,000 shares, that's $500 a day. As simple as it sounds to pull 10 to 15 cents a day out of the market, that's a solid first goal for a beginner trader. It will require being disciplined about trading the right stocks, taking really good quality entries where you decide your risk to reward ratio looks good before you pull the trigger. It also requires you to get green and shut it down. 10 to 15 cents a day is how you build a track record of consistency. It is only from that point that you begin to scale up. This concept of 10 to 15 cents will keep you from swinging for home runs too soon. When you first learn to trade, it's natural to want to validate your trading by hitting a big winner. But if I was looking at your trading history, I would not be impressed by the occasional home run because it might be due to chance. What I'd be impressed with is long strings of small base hit consistency. And just so you know, focusing on 10 to 15 cents a day is harder to follow than it seems. I recently took a position on a stock around $9.80. It squeezed right up to $10.50. I was up 70 cents a share, but I didn't take any profit off the table. In other words, I didn't sell even a portion of my position and keep the rest for a bigger move. It was an awesome trade, but I held the whole thing. It ended up coming back to break even. That was not a smart move. I forgot about base hits and I tried to catch a home run. Just so you have perspective, most seasoned traders are not taking a full $1 a share out of the market each day. For most, it's probably anywhere from 15 to 25 cents. On a good day, maybe it'll be 50 cents, and on an amazing day, it'll be $1 or more. Remember, I'm talking about the survivors here, the people who have dedicated their energy and time to learning this profession and who are highly disciplined. Of course, they also have the confidence to trade with 10,000 shares, and making 25 cents a share is $2,500 per day. The starting point is by focusing on consistently pulling 10 to 15 cents per share out of the market. Strong stock component number 4, an imbalance between supply and demand. Each morning, we're looking for a stock that has the potential to move 20 to 30% at a minimum. On a really strong day, we might see 300 or 400% moves. What creates this volatility is when there's an incredible amount of demand for a stock against a very limited supply. This comes back to float, the number of shares available to trade. But remember that for any stock, you have some shareholders that are not interested in selling their shares. So the actual number of shares truly available to trade on any given day is lower than the float. Let's look at a situation that I see as I'm writing this book. It's a stock with a symbol OBLN. I can see it on my screen and it has a float of 6 million shares, but it has traded 321 million shares today. On this day, OBLN is the darling of Wall Street. It is the most traded and most obvious stock. Think about those numbers. How many times have traders bought and sold that same 6 million share float? So the total number reached 321 million shares. That should give you a sense of the intense focus that the most visible stock gets on any given day. The goal is to identify these daily unicorns and to be disciplined in how you will trade them. If you could do these two things regularly, you just might succeed in this profession. Strong stock component number 5, high relative volume. The relative volume metric is where you will see amazing differences between the most volatile stocks and all the rest. It's not unheard of for the most volatile stock to trade 1,500 shares on one day and then 300 million shares on the next day. Now, this doesn't happen every day, but when it does, it's usually after some type of big catalyst, news about the company. Instantly, algorithmic trading systems execute orders even before humans can react. And then next thing you know, retail traders are jumping in. And now the stock is at the top of the list of the most active stocks worldwide, and things continue from there. Some traders will sell into this strength, having taken their initial profits. Other traders will see the excitement, they'll hesitate, and then finally buy out of FOMO. You will commonly see 3 things relating to a stock's volume. Number 1 is the float, which is how many shares are available to trade. Number 2 is the total volume today. And number 3 is the relative volume. The last number is expressed as a multiple of average volume. For example, if a stock has average volume of 150,000 shares per day, and yesterday it traded with 300,000 shares of volume, the relative volume ratio is 2. The higher the relative volume, the better. The reason is because it indicates a sudden interest in the stock, which typically results from some type of catalyst. In addition, the technical patterns that we use to trade generally respond better when the trading volumes are above average. Strong stock component number 6, former runner status. We've already discussed at length how FOMO can have a powerful effect on stocks. My point now is once a stock has been the focus of that mentality, it establishes something of a reputation. It's gotten exposure on countless trading screens and in chat rooms, and that exposure lingers not only for a few days, but in the minds of traders. Anytime that stock starts to pop up, it gets extra attention. If there's a strong daily chart and the stock has some fresh news, traders will be quick to jump in. They remember how strong this stock was in a previous trading session. For that reason, I have a stock scanner that specifically filters stocks that I consider to be former runners. I set the total volume filters a little lower on this stock because when a former runner starts to move, I want to make sure I see it quickly at the beginning of the move. During hot cycles, we see a combination of former runners, fresh top gainers, and multi-day momentum stocks that keep trending higher. I generally find that it's better to trade with the pack in the sense of focusing on the stock that has the highest trading volume. Sometimes a former runner will become the most obvious stock of the day, but other times they become a bit of a distraction. It's important to recognize stocks that are a distraction from the ones that are truly the most obvious. This is a skill that you'll gain over time. However, one of the metrics I look at to tell the difference is relative volume. If it isn't high, former runner or not, that stock probably isn't the right one to trade today. Another guardrail is in order. Guardrail number 15. I will not only look for the strongest stock today, but I'll ask myself, is this the obvious one? If you had to talk yourself into trading the stock, it won't be any more obvious to all the other traders, and it's not worth trading. It's much better to wait for something else that happens during the trading session or even wait until the next day. You could be forgiven if your head is swimming with day trading concepts, given how many we've covered so far. But I'm not done yet, because in the next chapter, you will find out about several more guardrails that helped reduce my risk as a trader. Chapter 11, Getting Better and Better. In the previous chapters, I've covered 15 guardrails that I had to learn the hard way. These guardrails, when implemented properly, can help you reduce the risk of unnecessary losses as a day trader. But to give you every advantage I wish I'd had when I got started, here are 5 more guardrails. Guardrail number 16. In retrospect, my goal should have been that I would be ready to trade when I had proven I was ready, not merely when I thought it was time. Despite all my warnings about how hard day trading really is, You might have become enthusiastic about the profession by this point. I think you can tell that I find day trading to be rewarding on many levels. On top of that, you are here, having listened this far into the book. Now, I can't blame you if you had wanted to put the book down already and just open a brokerage account and get going with placing that first trade. But I'm telling you, don't do it. Successful trading requires a high level of knowledge and discipline. As smart as I'm sure you are, and as good as I think this book is, you most likely don't have all the elements in place to be a profitable day trader just yet. Later in this chapter, I'll describe the very next steps you might take in order to continue building a solid foundation and advancing your day trading career. But right now, I want to remind you about a phenomenal tool that you can use to save yourselves all kinds of grief and money. I'm talking about a trading simulator. I discussed the simulator, or the sim, in chapters 3 and 5, but I want to emphasize it again here. So much in business and life is comprised of gray areas and judgment calls, but not with the simulator. For any period, you will be either red or green. Even though you could close up this book right now and start trading in a simulator, I suggest you not do that yet. On the one hand, I am a believer in beginner's luck, and you might just have it, but you might also lose so much money, even in the simulator, so quickly that you give up on the whole idea of day trading. What you should instead consider is finishing your next stages of learning from this book and from the next steps I'll describe shortly, and then ease yourself into using a simulator. It is so much better than being thrown into the deep end when you're not trained or ready for it. So let me give you a preview of what you're likely to discover as you begin trading. My impression from my own experience and having taught traders for over a decade is that there are several phases associated with learning. The first phase is beginner's luck, and the emotion is day trading is easy. I just sat here, I clicked a few buttons, and I made cold hard cash. This is awesome. Which leads to the second phase of overconfidence. Traders will say, sims are for losers, I'm a natural at this, I'm putting real money on the line. This leads into the frustration phase. And the emotion is, what's happening? Things were going so well, and now suddenly I am losing. And it's real money at that. Many people quit here. Those who continue often go into a phase of no visible progress. I can't believe how hard trading is. I'm sticking with it, but it feels like 2 steps forward, 3 steps back. More people will give up in this phase. It was during this phase that I had my big loss that nearly put me out of the game, but I used it as a catalyst and it became my turning point. The next phase is the slow climb. This is when you realize you're making progress. It's not fast, but it certainly is hard earned. As I described in my own journey in chapter 2, it took me a while to realize that being a break-even trader is actually a huge accomplishment. You're keeping your head above water. Only after I identified my winning strategies and stopped the losing strategies did I begin to see consistent upward progress. What I didn't know at that time, but you do now, is that you don't have to experience all these phases of learning with real money on the line. Real money on the line only amplifies the emotions. The simulator is your friend, where you can experiment, learn, and hone your skills until you're producing regular green weeks. I don't know of any other better way to learn this profession. Later in this chapter, I'll give you some details on when you're ready to transition from the sim to trading with real money. Guardrail number 17. I keep a trading journal and update it after each trading day. Earlier, I told you it was only when I studied my past trades, when I was broke and down to my last shot at trading, that I found a way out. It was a path to climbing back to profitability. That insight did not magically come to me in a dream. It resulted from hard work to uncover patterns I hadn't noticed before. In the heat of the moment, it's tough enough to keep a clear head, beat back emotions, and stay within the guardrails as you trade. That's asking a lot. But if you take the time after your trading hours to study your trades, pretty soon you'll gain insights. There are some great tools that exist to take the manual labor out of tracking each one of your trades, but it's also possible to keep your journal right in a simple spreadsheet. You should track the type of setup, the time, the symbol, the entry price, the exit price, how much you made or lost, and your notes about the trade. I don't mean to suggest that you should stop every few minutes to log this information in your journal in the middle of the trading session, because there may not be time for that. But instead, all the information is available to grab after you finish trading. Just don't put it off for days thinking you'll catch up on it over the weekend. It needs to be a quick habit while the trades are still fresh in your mind. while the notes section will still describe what you're thinking in those moments. Though you capture your journal data daily, you might review it daily or every few days, but certainly at least on a monthly basis. You're looking to get a deeper understanding of where you have strengths, where you have successes, and where you need to make adjustments. For example, you might notice that most of your profits happen in the morning and your biggest losses are in the afternoon. Now you can make a note to review the guardrails before afternoon trading and be more mindful of that pattern. Bringing both positive and negative habits of your trading into your awareness is an important step in refining and improving your strategy. This brings us to the next guardrail. Guardrail number 18. I regularly analyze my journal for clues about the conditions that generate green and red days for me. When I'm in a slump, I study my journal even more. Even what appears to be trivial improvements can really add up over time. If you trade, let's say, 50,000 shares per month, and you can improve your average profits by a single penny per share, that'll increase your profits by $500 a month. Another way to look at it is that the difference between success and failure in this business can be the matter of only a slight adjustment in your ratios. When you're reviewing your trades, first notice where you may have violated one or more guardrails. That's a no-brainer analysis because it's not like you need to scrutinize the statistics in order to discover a hidden insight. Maybe in the heat of trading, you ignored your max loss. For the next session, you'll have something specific to write yourself a note about and what to watch out for. The day trading personality. I've met a lot of great people in the day trading community. They're from many walks of life. Rich, poor, highly educated, dropout, men, women, from many countries, and the list goes on. But there seems to be at least one common personality trait among the sort of people who are attracted to day trading. They are independent thinkers. We live in a culture that values concepts like slow and steady wins the race. But we day traders want to win the race now. We're looking to make a month's worth of conventional investing profits in a single day. We're willing to endure the awkward silence and uncomfortable relations that follow when we tell people we're day traders. However, the very independence that gives us the strength to be in this business can also work against us, and I'll give you a few examples. On several occasions, I've spoken with traders who have gone through my training and are having problems. When I ask for details about exactly what they're doing, I come to find out they're trading on a mobile app. They're using their phone. That is a mistake. I am aware currently of 0 professional day traders who base their business on a trading app on their cell phone. In order to succeed at this difficult profession, you need to have several windows open on your laptop or desktop, and you need to be fully present, not multitasking on your phone. Of course, many people know my opinion on this, and certainly all of my students would as well, but that independent streak can sometimes lead to ignoring the lessons I share that have come from over a decade of full-time trading experience. Another example is when I'm discussing strategies with someone and they say, oh, well, I can't really do what you're suggesting or your strategy because my account is only $700. Now, I think it's great when people start out after trading in the simulator with a small account and build it up from there. The problem happens when this person has a bit of success and builds it from $500 maybe to $2,700 and decides to pull $2,000 out of the account to spend on other stuff. Yes, of course, it's their money. They can do whatever they want with it. But the reality is you have more options and flexibility when your account is larger. Day trading is the very hardest and the slowest when your account is tiny. So why are you making it perpetually challenging on yourself by pulling all your profits out of the account and going back to the minimum? In a video I created, I talked about my hobby of making maple syrup and how that relates to day trading. In case you don't know, making maple syrup, or sugaring, involves collecting sap from sugar maple trees in the late winter and boiling down the sap into maple syrup. There's a traditional way to do it, and then there's the way professionals do it now. Whether it's sugaring or day trading, it's worth looking at how successful professionals approach the business, instead of deciding that you know better and want to do things differently. Guardrail number 19. In retrospect, I've realized that I could have saved myself a lot of time and money by resisting the temptation to blaze a new trail. When I'm learning something new, I now follow what the professionals do as much as I possibly can. You are an independent thinking beginner. Successful day traders are independent thinking professionals, and yet the vast majority of them follow certain common practices. You are undertaking a challenging profession. It's a mistake to decide to blaze a new trail with your ideas about how to take a shortcut to success. or to cherry pick the concepts you wish to follow. The only real shortcut to success is to not make the mistakes that other people made who came before you. Stand on their shoulders and follow the proven principles. If and when you become successful, by all means, innovate away. So what now? If I've done my job in this book, you should be thinking one of two thoughts at this point. The first is, wow, I am pretty sure that day trading is not for me. I thought it might be a cool little hobby that I could do now and then to make some easy money, but it sounds like a lot of work to get good at it. And the second is, I didn't know what day trading was really about, but I have a better sense now. I feel like I may have the personality and the interest to pull this off. What I don't know are the exact next steps that I need to take in order to continue to learn about day trading. If number one sounds like you, then reading this book has been time well spent. You saved yourself all kinds of difficulty and cost to find out that day trading is not a good fit. Who knows, maybe your circumstances might change and day trading will turn into a good option for you to pursue down the road, and that's fine. If number two sounds like you, then I'm glad that you found this book to be useful. Fortunately, the next steps in your journey are pretty clear. Before we get into it, a warning. Do not be discouraged by the amount that you need to learn. You're not in a race, and besides, you probably have lots of skills, sports, hobbies, and other activities that are made up of dozens of individual micro skills. I know that I'm a broken record here, but I also know how beginners need encouragement to keep going. In fact, from time to time, all of us need it. So here are your next steps. Step 1, build a solid basic foundation of day trading knowledge. In this book, I've been able to cram in merely an overview of the concepts you need to know to even sit down at a simulator and begin trading. As safe as a simulator is, it's a mistake not to build your knowledge base before trading there. That's because you could become easily discouraged and throw in the towel if you don't have the right knowledge in place before you begin. The knowledge I'm talking about is not boring, it's not dry textbook stuff. And if you've read this far, I'm pretty sure you'll find it interesting. So here's a list of the next topics you should learn about. The first is a deep dive of each of the windows or screens that you'll have open on your computer monitor. You'll need to know how the software works, and you'll need to know all the terms, all the numbers, the chart lines, and what all the patterns mean. The second is a deep understanding of technical indicators. There are thousands of them, but most are overrated and unnecessary. A technical indicator is a mathematical calculation that's presented in visual form that may, or may not, put the current price of a stock in context so the trader can decide whether to buy, hold, or sell. The more useful technical indicators that I use include simple and exponential moving averages, the volume-weighted average price, moving average convergence divergence indicator, and the relative strength index. The third thing you'll need to understand is the concept of support and resistance and how to determine where past and current ones are for a stock. All stocks trade within support and resistance channels, and by understanding these channels, you can better understand your risk when you're considering taking a trade and your profit potential. The fourth concept is of gaps, windows, and triggers. These are formations that we'll see on daily charts, and they help us better understand upside potential and areas of resistance. The fifth is understanding different types of brokers and deciding which one is best for you for when you open your first account. The sixth piece of knowledge that you must have is on order types, when you should use limit orders, market orders, and stop orders. You'll also need to know how to execute orders pre-market and after hours, and how to harness the power of advanced order routing technology. The next thing you'll need to know is how to read level 2. We touched on this, but you must get comfortable with this fire hose of useful real-time data, and you need to be able to interpret what it's telling you. The eighth skill goes hand in hand with the seventh, and it's the ability to read the time and sales. The time and sales window will show you every individual transaction that occurs on a stock, and it'll tell you whether it occurs at the bid price, which is bearish, or the ask price, which is bullish. Traders who can read the tape will be able to respond to changes in price action far quicker than traders who rely on technical indicators alone. Number 9, you'll need to understand how to use your order entry window and how to script hotkeys in order to save time when you're in the thick of trading. Number 10, without a doubt, you'll have to be an expert at reading chart patterns. You can go a little crazy trying to learn too many patterns because there is no end to them. At first, get familiar with the most useful ones, which, in my opinion, have the highest likelihood of resolving in the right direction. These include looking for the first and second pullback on a strong stock, flat top breakouts, flat bottom breakdowns, bull flags, bear flags, moving average retracements, buying a higher high after a pullback using a 5-minute uptrend, parabolic moves, head and shoulder patterns, and the ABCD pattern. And number 11, you'll need to know how to use stock scanning software and how to build a watch list each morning. You'll learn how you can customize the software so you can sit down in the morning and already have a tight focus on what you might trade that day. Once you've built a solid, basic foundation of day trading knowledge, it's time to advance to step 2. Step 2, find a strategy that's a good fit for you. By the time you're familiar with the material I listed in step 1, including trading patterns, you'll be able to pick out a strategy that resonates with you. Something will stand out. Just don't try to reinvent the wheel with your own custom strategy at this point. Instead, decide on a strategy that someone else has proven profitable and learn it. Now, you're not taking any type of final vows here. You can always switch strategies later on. Your goal at first is to learn one strategy thoroughly, inside and out, instead of being superficially familiar with a number of strategies. Step number 3, create or adopt a trading plan based on your strategy. Your trading plan will be a thorough document that spells out in specific detail how you intend to trade. Here are a few of the items it'll cover: your maximum risk per trade, your profit target per trade, your daily profit target, your trading plan goal, the number of trades per day that you'll take, what price stocks you'll trade, what float you'll focus on, what time of day you'll trade, what time you'll stop trading, and many more. It's specific enough that you could hand it to another trader and they'd have a very clear idea of what to do and when. It's similar to a pilot's flight plan, which is a detailed description of the destination, the route across the country, different altitudes, and so on. Trading plans and flight plans still leave room for judgment, but they are how professionals plan their actions. I provide members at Warrior Trading with my day trading plan for beginners. It's the plan I've used every single time I've done a small account challenge. My trading plan is based on a momentum strategy and includes a position management technique designed to capture small, base hit winners with a high degree of accuracy. The drawback to focusing on higher accuracy is that you sacrifice your profit-loss ratio. I'm okay with this because as a beginner trader, high accuracy is important for boosting confidence. Whether you use my trading plan or you use one from another trader, what's important is that you have the discipline to follow it and that you carefully review your metrics as you accumulate historical data. Step 4, trade in a sim. Now I'll modify this a little bit to say that if you open a small account and use real money, but use tiny position sizes, like 1 share or 5 or 10 shares, that could work too. Some traders prefer this over sim trading because they want to begin the process of emotionally conditioning themselves to experiencing loss. My main problem is that it can become a slippery slope. A trader may not intend to trade with anything more than 5 or 10 shares, but then suddenly enter 1,000 shares by accident and then become emotionally hijacked and start revenge trading. So whether you trade in a simulator or you trade with real money with tiny position sizes, it's important that you feel no real monetary pain until you're well along in the learning curve. Every beginner makes plenty of mistakes, and of course I was no exception. They are inevitable, but it's better that those mistakes have as little financial effect as possible. Step number 5, review your metrics regularly in order to make improvements to your strategy. While the strategy you're trading may be proven, your metrics and your ability to execute on the strategy may leave room for improvement. While you're still in the simulator, continue to lay a strong foundation by focusing on your metrics. The ones you want to look at most closely include your accuracy and your profit-loss ratio. In addition, you'll want to monitor the number of weeks in a row that you've been green. We all have red days, so don't sweat that. The real test is to be green for a string of several weeks. If you could do that for 5 or 6 weeks, something must be working in your profit-loss ratio and your accuracy. Of course, these 2 measurements alone are not enough because you could have great accuracy and a pretty good profit-loss ratio, but as you learned earlier in this book, you could have 1 or 2 huge losses that put you red overall. That's why it's important to see the consistency of green weeks happening back to back to back. The final guardrail I want to share with you, guardrail number 20. When starting out, I should have made just 1 trade per day until I could show 5 or 6 green weeks in a row. Now that may seem overly restrictive, but I think it's good advice. When your goal is a single trade per day, you become very picky about what you're willing to trade. You sit back and you watch what's happening and you don't jump at the first interesting pattern. especially when you're starting out and day trading is a fire hose of data streaming at you in real time. Your goal number one is to make sense of it, and your goal number two is to take a trade. So watch intently, study the patterns and the data, and make that one trade be the best you can do today. Your goal is 10 to 15 cents of profit out of the market per day. This is the shortest path to building confidence. By the way, it's a good idea to print out candlestick charts for the stocks that in hindsight were great examples of the strategy that you're focusing on. You're a hunter of volatility and a manager of risk, so take a good picture of your prey and stick it where you'll see it. You'll be more likely to recognize it quickly the next time it shows itself. Now, some of you may be thinking, Ross, earlier you said it was a good idea to scale out of a position and not sell your entire position all at once. Now you're saying I should limit myself to one trade at first. So how can I scale out with just one trade? You're right, I did say that, and I was referring to the circumstances you will eventually experience when you have a sizable position and you're also making several trades per day. When you're just starting out with small share size, it's not practical or necessary to scale. In this phase, beginner traders should focus on one entry and one exit. Get in, get green, and get out. Rinse and repeat. Now, there's one other thing that needs to happen while you're trading in the simulator. You'll need to get through your first drawdown. Even if you're just making one careful trade a day, you will inevitably catch a big loss at some point. Maybe it was an emotional mistake, maybe the stock acted crazy and it wasn't something you could have avoided. In either case, the loss is a lesson, but it happens and it needs to happen to you so you can learn how to handle it. You do that by not beating yourself up, but instead by going to your journal and figuring out what was the cause of the loss. You'll also remind yourself that you've made many positive trades and you're still that same trader. You'll then either fix your approach if you forgot something, or move on and work to recover in the sim the money you've lost. Once you've made that first recovery from a drawdown, you're ready for a big milestone. Step 6. After you have those green weeks and have recovered from a drawdown, now it's time to begin trading with real money. The first time you trade with real money, you'll already have some experience and a track record of green weeks. Even so, no matter how good you were in the simulator, you'll discover that trading with real money is a little different. Therefore, expect an adjustment phase. So how is it different? Well, for one thing, you knew all along that you were trading in a simulator. You had a safety net. Now, the emotions of trading with real money will change the experience. You'll have the positive boost that comes when thinking to yourself, I just made more money in the last 10 minutes than I made in a week at my first job. Enjoy the moment, but don't let it go to your head because soon enough you'll be thinking the opposite. What just happened? How could I have lost that much money in the space of 10 minutes? And by the way, remember to be careful with whom you tell about your real money trading outcomes. Outsiders who don't know the methodical process you're following may give you the opposite of the support you need. They may say, are you out of your mind? That's a month's rent you just blew in your little day trading thing. So you're better off keeping your head down and staying quiet, or at least giving just general descriptions of how things are going. When you transition to real money, don't be surprised if you feel you've lost a bit of the momentum and confidence you built in the sim. It's natural, and you know what to do. Keep the guardrails in view, execute on your trading plan, and review your journal. You do that, and soon enough, you'll build back up that momentum and confidence. Step 7. As your metrics support it, begin scaling up. This means adjusting the guardrails a little bit. For example, if you've been trading with 100 shares, then move to 200 shares. It will potentially double your profits and your losses, but it will not double the workload the way moving to 2 trades per day would. When you do increase the number of trades you take each day, you're statistically more likely to see 1 or more red trades, and that risks an emotional setback. After 2 or 3 weeks with increased share size, assuming you're still pretty consistently green, then you can bump up the size again to, let's say, 300 shares. The goal is slow, incremental increases while trading at the edge of your comfort zone because you want to grow, but not so fast that you risk wrecking your confidence. Acclimate yourself so you experience those losses and rebuild back. Narrow the guardrails if need be, but focus on bouncing back after the next drawdown. Continue this process until you're making one trade of 1,000, 2,000 shares or more. Once you've built your skills and confidence to do that with consistent profits, now it's time to think about scaling up to 2, 3, 4, 5 trades a day and so on. I want to remind you that it's far more important to build confidence and skill than it is to build your profits. If you do the first 2 right, The third will come over time. Profits are a byproduct of a disciplined trader with some experience and educated intuition following a proven trading plan. The following isn't so much of a guardrail as it is a best practice. Try to participate in a community of traders where you can surround yourself with like-minded people who are trading in a similar way as you. If you build a trading plan that focuses on trading small caps with the gap and go pattern, then ideally you'll have a few friends in a chat room where you can talk over what you're seeing today. You will benefit in 4 ways from doing this. Number 1, you'll enjoy the camaraderie with fellow traders who get you and who understand the ups and downs of day trading better than anyone. Number 2, more eyes on the market at the same time will help to prevent missed opportunities. Number 3, over time, you'll develop trust with a few people who will give you honest feedback about when you're doing well and when you're not doing so well. Number 4, you can benefit from mentorship and support from more experienced traders. In a profession with as much uncertainty as day trading, I can say this for certain. Good communities exist where you can get valuable and even crucial support, and you can make some great friends too. I have to congratulate you because you've made it through this whole book, which was not some easy money promise, but instead, I hope, a candid description of the skill and discipline necessary to become a day trader. I also envy you, what I wouldn't have given for a guide like this when I started out. Nothing even remotely like it existed. I shudder to think of the money and stress I could have avoided had there been one. I also envy the environment you're starting in. Technology has come so far in the past decade that it takes a lot of the manual drudgery out of trading. Notice that I didn't say it made day trading easy. It's just that now we have a much more high-resolution picture of the markets rather than a grainy, narrow view. In addition, the markets have never been more accessible than they are today. And one of the great things is that you don't even need an account or a ton of money to start learning. You know, my advice is to trade in a simulator before you put real money on the line. You could do that for free right now with many brokers. I told you at the beginning of this book that I'm going to be as truthful as I know how to be about what it takes to be a day trader. So allow me to be truthful about something else. I would love to see you become a member of my community at Warrior Trading. We are by no means the only game in town. You have far more choices today than I ever did when I was getting started when it comes to trading education, tools, and community. You could take what I've given you in this book and you can go off and be a trader wherever you choose. The lessons I shared here are agnostic. These lessons will help you better understand the universal language of the financial markets. And you can use any trading tool or be part of whatever community you'd like. Even so, I hope you'll check us out and see if we're a good fit for what you're after. If you go to warriortrading.com/bookbonus and leave your contact information, 2 things will happen. Number 1, I will respect your privacy and I'll never sell or give away your contact info to anyone else. Number 2, I'll send you a package of additional materials I couldn't fit into this book. That's the beauty of the age we live in. It's easy to deliver information electronically and instantly. No matter what you decide, I want to thank you for reading this book and thinking about maybe, just maybe, becoming a day trader.